Hello, my dear friends, and I'm sure you all are doing great. Carrying on with the same high level of energy that we had yesterday. And I'm sure the topics that we covered in elaborated mode yesterday, they are absolutely crystal clear. So, day one of the session we have completed. Now, remaining topics I will be covering in day two, that is today. So let's just have a quick look at what all topics we covered yesterday. In the yesterday's session, that in case if you have missed out, people don't forget to go to that video that has already been uploaded on my channel now. That is a complete 4 hours video that is where I have completed all these topics, and now the remaining topics we will quickly revise them today. Okay, now we completed throughput accounting, environmental and sustainability topic, target and life cycle costing, relevant costing, limiting factor analysis, pricing decisions, risk and uncertainty, quantitative analysis, and CVP. Yes, all these topics in detail with some examples also we have covered yesterday in the class. Now let's cover more portions and the remaining portions so that after this and after completing the marathon sessions and the other useful section C videos as well, you will be exam ready, completely ready to give your exams this week. Okay, so let's have quickly the first topic that I'm going to take up today is budget and budgetary systems. Okay, so eyes on my screen when I take that topic. Okay, first thing that I would like to discuss quickly is, ma'am, what are budgets? Budgets are nothing but the targets, the standards which are set by the organization for the entity to achieve for a particular period or over a particular period. And entities' budgets don't come directly just as a budget statement. They are basically a refined or a filtered form of the mission that the entity has prepared. So entity always fixes its mission statement. That's a broader picture. Then it basically, it kind of shrinks them into the long-term plans, around 5 years or 10 years plans, that we also call as strategic objectives. And then it sets its annual plans, and where it comes the short-term objectives that we call as budgets, right? So budgets are nothing but the short-term targets or short-term objectives that are generally up to a year only and not beyond it. Now, so budgetary system is what? It is nothing but it is a series of steps so that we can achieve the control over the financial statements of the entity. Clear? Yes, absolutely. Now, what are the purposes of a budgetary system? So before that, let me just give you a briefer. Okay, I would want to cover it quickly here because many students ask me, ma'am, what are the different types of budgets? And there they always have a problem because the basics, yes, we need clarity on. So let's just quickly have an understanding quickly on the three types of budget that are major, the major category that we say. First type of budget is fixed budget. The second category is flexible budget. The third category is flexed budget. And I will give you the key summary points that you need from exam point of view. Number one, the first difference between the three types of budgeted boss, this is the main budget. Or we call it is the master budget. So what is the use of a master budget? It is prepared at the start of the period only. Okay, it is prepared at the start of the period only. Okay, so it is a master budget that will remain throughout the period like a fixed budget. It will never ever change. Flexible budget is a budget. This is budget prepared for changes in conditions in the current year. So after your period has started, but now you find changes in your conditions. Okay, now you find changes. So due to those changes which are there in the conditions, you need revision in the budget. So therefore we call it as revised budget, that will keep on changing with the changes in the budget. Okay, so it is the changing budget. Fixed budget is a fixed budget. Flexed budget is a budget prepared with actual units. So it is a budget that we prepare with actual units. What is the purpose? The purpose is to understand that let's have the units fixed. Then what is the difference? Why the targets are not achieved as per the actuals? Okay, so this is where your actual units are used. So second point is here, which units you will be using? Here you will be using original budgeted units. Here we will be using revised budgeted units. Okay, from your exam point of view, it is very important. You will always find questions, wherein you have the budgeted level differences. I know it's more of an MA topic, but in PM also you find questions in your MCQs as well. And here you have that we use actual units. Done. Third, very important point, the cost per unit. The cost per unit or the revenue per unit, whatever you take, will be as per the original budgeted figures only. That means here you will have original cost, original budgeted cost, original budgeted cost per unit. Okay, and here you will have original budgeted cost per unit only. But you will say, ma'am, it is a revised budget. In a revised budget, only units get changed. In a flex budget, only units get changed. But the cost per unit remains same as the original budget. So original budgeted cost per unit, and the same here. Original budgeted cost per unit. Okay. So, and just the last point I would like to highlight here is fixed cost total is as per original budget. Here also same, fixed cost total is constant as per original budget. Here also, so remember guys that this is going to remain same. Okay, fixed cost budget, no, fixed cost total, because fixed cost in total is constant, is as per original budget. Okay, and the last point is, when we do variance analysis, we never use original budget to compare with actuals. We never use flexible budget to compare with actual. We always use flexed budget. Yes, when we do the basic variances, yes, you will always find that in some places like fixed overheads and all. So it's a mix of a flex and a flexible budget that we use for overhead, the variance calculation. So anyways, so these are the four main differences, guys. Have a hold of it, and don't ever forget the difference between fixed, flexible, and flex. It is very important for your exam point of view, because this is a basic point that students get mixed with. Okay, now let's go forward here and let's understand what is the purpose of a budgetary system. The purpose of a budgetary system is very, very simple. It is just that, see, the focus is always that we should be able to do performance evaluation with the budgets when we compare them with the actuals. Okay, and we should be always, in fact, we should also be always able to do the plan, the controlling purposes to understand that why there is a variance. If I say that, look, material price variance is adverse, why it is adverse, so going into a deeper understanding of it, so that next time or in future your variances convert into favorable rather than adverse. Okay, then these are to be communicated, these are to be coordinated also, these are to be communicated, coordinated well with the overall objectives of the organization. Highly important. Okay, These have to be well coordinated with the overall objectives of the organization. Then resource allocation has to be as per the requirements of the organization, correct? So in total, I can say in brief that look, my budgets are the ones that help me to make sure that the organization objectives are achieved with the utmost efficient resource utilization. Done? Clear? Great. Okay. Role of budgeting in the long-term planning. What is the role? Why I'm discussing this? When you have MCQs, this becomes very crucial. So therefore, it is important to be discussed to you. Now, just 1 minute. Number one, the role of budget is to establish the long-term objectives. We have already covered. Number two, to produce the annual budgets. Number three, then from the annual budgets we can create sales forecast, and once you know the sales forecast, then you can create all the other budgets like the different purchase budget, production budget, cost budget, departmental budget. All the budgets can be done. So you can see that sales budget is the main budget, okay, and the different budgets that you prepare are the different functional budgets. Then board's approval is needed to approve them. Then we compare budgets with the actuals. We have the variance analysis done. We evaluate the performance on the managers on the basis of it also. We look deep dive into it, why there's an adverse variance, why there is a favorable variance. Done. That's all. That's all is the theory part that you need. Okay, that's all is the theory part that you need. Now I take up this very important part. Guys, sustainability and environment and the ethical budgeting is not a very big area in your syllabus. It's not at all. But what is important is just to understand the brief about it, because your syllabus in ACCA is moving deep dive into sustainability. So you would always be having at least one question in your exam. At least one question in your exam that will always be there on sustainability. So you got to be absolutely ready with it. No, sustainability in ethical budgeting is budget should account for sustainability also while the revenue and the cost budgets are being prepared. That means if I'm preparing a cost budget, maybe the expenditures that have gone towards sustainability, environment, society and all should be highlighted separately over there. So for example, I've given an example also for the same. Carbon emission reductions, they will always result in savings. Savings is good for the entity. So it will help in reduction of the cost. Now this should be clearly reflected in the budgeted cost also. That means while we prepare the budget, we can have a subpart, some categorization also showing the savings that are made. Okay, and that is going to improve the public image. So overall, it's a very good thing for the entity to ensure that these budgets are prepared, and the sustainability is a part of your budget preparation process. Okay, now I take up this very important point, and this is the interrelationship between the planning of budget and the control. Almost I'm repeating the same point only that I started with, but budgeting is a topic, budgetary system is a chapter which is not just important for section C, but it is a hot favorite topic for multiple questions in section A. And when these theory points come in, students get confused. So I know your confusions must have been removed when you have watched section A and B marathon videos, but I still want to highlight here the theory related pointers. Okay, so look at my screen. Interrelationship of planning and budgeting and control, of planning and budgetary controls is with the plans, and we set the targets. Then these targets are compared with actual performance. We have variances. We take the controlling action to see why there is an adverse variance and how can we better even the favorable variances. Okay, so now here we look into the reasons for the same, that why the variances are there, and we take corrective actions to ensure that the gap between the budgeted and the actual performance is reduced, or in fact is nullified only. And if there is a need to make the changes in the plans, we make them also. With which variances we do that? Can anybody tell me which of the variances, a particular category of variances are there that help us to know if the standards are needed to be changed? Anybody can type it in the chat box. Can anyone type that? There is a particular category of variances. And the purpose of those variances is to know that whether any fault is there in the budget setting process, so the standards can be changed. Put it in the chat box in case if you know this. Anyone can answer this? Which are the particular category of variances that help us in understanding this? Let me give you a help. The mixed variances, yield variances, planning variances, operational variances. Which of the 4 options that I've given you, if there is a change needed in the standard setting process, which of the variances would tell us about it? Quickly. Quick, I'm waiting. Okay, let me tell you this. The planning variances would always guide you when there is a different, when there is, some changes that we need in the budget setting process or the changes that we need in the plans. So, and that is the planning variances. Please don't forget it. It's very important to remember for your MCQs. Okay, let's go ahead with the next one. Now, when you know there are favorable variances, then what would you do? It would show that no control action is needed. However, monitoring is needed to ensure that there is an accuracy of results, which is there. Plus, we can even better the favorable variances. Okay. Now, next, I'm taking a very important pointer here, which is feedbacks in control. Very important point here, feedback in control. So you can have a negative feedback, you can have a positive feedback, and the next one is feed forward control. Understand that when we have a negative feedback or a positive feedback, we base it on the basis of a past data, correct? We base our negative or the positive feedback on the past data because the period has already gone, and now what you do is now we analyze what was the target, what was the actual performance, because we do that at the end of the year. So at the end of the year we will compare between the target performance and the actuals, and then we get the variances, and then we try to improve for the future, correct? So the period has already gone by. Now you cannot change that, but what you can only change is in the future period. Correct. So when you do the budget analysis for a past period, then we have a negative or a positive feedback. But now I want to do the steps I want to take place already in advance for the future, so that in future I may not have the variances. So I already want to take the steps right now for the future only. And that is where feed forward control comes in place. Now in feed forward control, we will not compare between the past budgeted data and past actual performance. We prepare estimates. Okay, we do models and we prepare estimates based on which we estimate what can be the potential variances that may arise. So right now only I make the relevant changes so that in future I may just eliminate those variances. So you are taking the actions in advance, and that is where feed forward control comes in place. Clear? So it is basically making the changes in the future estimates so that the control is taking place in advance and you're not waiting for the year to go by and then analyze the variances. You're doing them well in advance. And this is where feed forward control comes in picture. Now, what are the different feedbacks that can be there? Okay, where the control action is adopted. Okay, the feedbacks where you have the control actions being adopted is, now you can have the 2 type of feedback. Look at my screen very clearly. Single loop feedback, double loop feedback. Single loop feedback is, for example, sales target was 1000 units and we achieved 800 units. Now the entity is looking for ways to improve actual performance rather than we are aiming at changing the targets. We think that the targets were set accurately, actual performance was not done properly. So now we look at not really manipulating or changing the targets. We look at only making sure that the actuals get improved. This is single loop feedback. Only one side we are looking into actual performance. Let's say double loop feedback, very easy. Double loop feedback is where you look at actual performance as well as the targets. That's all. For example, in case of a sales target of 1000 units, actual sales have been 800 units. Now the entity will focus on changing the target itself along with looking into actual performance. Okay, so in double loop feedback, not just your actual performances are monitored or controlled, but the targets are also looked into. So the management may just look into it and they decide that okay, the targets were set really high, so they may just change the targets only. This is double loop feedback, double side. Targets and actual performance both are edited. You can say that. Okay, both are controlled, both are monitored. So generally this will only take place when the adverse variances are persistent or consistent. So when you see them that the continuous period on period basis you are having the adverse variances, so then it shows that probably there has been a problem with the targets as well. Actuals have always been monitored and controlled, but now we need to see in detail the targets. So there the double loop feedback comes in picture. Done? Clear? Okay. Okay, now I am doing this. So I'm going to take up the different budgeting methods one by one, explain you there quickly. And we have done multiple questions in the marathon, so please go through the same as well. If there is a need, I'll take up just one or two questions in the class as well. Okay, right now. Now, what are the different methods to prepare the budgets? Number one, either we can do it top down or we can do it bottom up. So please look at my screen. Now, in top-down budgetings, the budget is prepared by the top management and is transferred down the line to the lower level management. So it's kind of a dictatorship where the management have prepared the budget and the lower level people are really not involved in the budget and they have been given the budget. Now they have to follow it. Yes, many times they accept the budget also, like the non-current assets budget, the investments budget, they're generally set by the management only. And the lower level people, the operational people, the middle level managers, they generally just follow this and they follow this with acceptability. But not on all areas it can be acceptable. For example, when they're setting the sales target, when they are looking into the cost budgets, the people who are actually working towards the targets, who are actually doing the production activities, sales activities, doing the day-to-day regular expenses, they may not just agree with the budgets which are set by the management above. So there we can have some some disagreement being there. So therefore then we have another type of budgeting approach also, which is bottom up budgeting. But now let's just have a quick look at the top down budgeting. So when I look at the top down budgeting, I can see that budget is prepared by top management and passed on to the lower levels of management for implementation. Budget is generally prepared by the top executives or the senior management, and the flow of the information is from top to bottom. Very little participation of lower level staff, and however it really needs to be realistic in order to be passed, in order to be in order to be used by the lower level management. Okay, bottom up budgeting is now where the operational people, middle management, everybody is involved in the budget setting process. So inputs are taken from all the managers, all the operational people, and then it is passed on to the management. It's a good process, everybody is involved, but it's going to be very time consuming, very lengthy process, and it may just take more time than expected. But not all areas can be used for bottom up budgeting, because if the expertise of the managers is not in that area, then the budget may not be of use. So therefore we always use practically a mix of bottom up and top down budgeting. Clear? Yeah, but the best part is that it is very much acceptable to the employees, as they are the ones who have set the budget. So they are naturally inclined to accept the budget. Okay, and they feel a part of the budget. They feel motivated. There is goal congruence because they consider this budget as their own budget. Then, right? So they are very much into the budget. Clear? Now, one very important point in the bottom up budgeting, we can have a budgetary slack. Budgetary slack is where the managers intentionally they overestimate the cost or they underestimate the revenue. Why would they do that? So that if they already give overestimation in the budget and then actually when they incur lower expenses, it would look like they've done good performance. So they would get good bonus, those good rewards for the performance that they've done because their performance is evaluated on the basis of the budgets or the targets that they have achieved. So in order to show a good picture, which is actually a fake picture, budgetary slack can come in place. Clear? Okay. So it is intentional underestimation of revenue and overestimation of expenses done by the managers to make the performance look better and to show that every achievement or the achievement of budgets have taken place. Plus, the managers will be very relaxed. They don't have to do much efforts as they've already given inflated expenses. Okay, for example, a target of 600 units was fixed for the revenue, but actual performance is 750 units because we underestimated the revenue, right? And so it would show a good performance. I hope everybody is with me. Now let's go to the next step of budget. The next step of budget is rolling budgets. Rolling budget is also called as continuous budget. Okay, why are the rolling budgets called as continuous budgets? I think I can give you quickly an example of the same. So let's say you have year 1, quarter 1, quarter 2, quarter 3, quarter 4 data, and for this we have prepared budget. Okay, now actuals have taken place for quarter 1. Once you have actuals taken place for quarter 1, now you will prepare the revised budgets based on this actuals. And for which quarters you will prepare now? I will prepare revised budget for quarter 2, for quarter 3, for quarter 4 and year 2, quarter 1. Because at any time we will have this 1 year budgets always there. So when one quarter ends, the next quarter will get added to it. And we will revise the budgets based on the actuals that have taken place for 2 reasons. First, it will be very easy to do. Second, it will be very realistic. Plus, you will always have 1 year budget picture in front of you. So, you would know when you are agreeing to an order status for the client as well, you would know what is the current targets that look like for the coming 1 year. Right? So hence rolling budgets are very, very useful over there. Now quickly. So here we prepare budgets for the next year, which is year 1. And we implement budget and we monitor the performance. We review the results and update budget quarterly. Add new quarters budget to extend the plan ahead. And it is going to continue continuously for a 12-month budget cycle always. Okay, it will be continuous budget. It will get rolled on period by period basis. Okay, now I want to give you this comfort, guys, whatever topics I'm covering. In case anywhere you've had a query that you want to discuss and share, you can always put it in the chat box and do the same. Okay? Okay, now incremental budgeting is the next budgeting process that I'm taking. Incremental budgeting is the most common budgeting process. Most common because you would always do that. Okay? What we do is we use the current year's budget and that is the base budget. So either we can take the current year's budget or current year's actual results. Whatever is the case. See, many times we take budget, but many times we take the actual results also as a base. Nothing given in the question, you will take actual results as the base and make the incremental budgeting. Okay, so what you would do on that, you will do small adjustments like For example, we are expecting cost to go up, we will increase it by, let's say, 10%. We increase revenues to go down, I will decrease it by 5%. So I'm not looking into anything from scratch. I'm just taking a base figure, and on that I'm doing the additions or subtractions of the percentages. Clear? Now, generally it is used for the well-established processes and the ones which are regularly, I mean, they have the same pattern, everything is same, it is well established, there is no major change that we are expecting. So yes, then we use incremental budgeting over there, because then the market standard percentages will be used for increase or decrease. Generally, it is used for efficient and stable environments. It is more relevant for achieving the stable equilibrium, and it involves minimum changes to the plan. So I would just give a bit more detailed here, eyes on my screen. It is a method. It is a budgetary method, actually budgetary system. It is a budgetary system which considers current year results, no, previous year results, okay, that can be budgets or actuals as per the questions you will do. Okay, budgets as a base on which a percentage increase or decrease are applied, taking into account expected growth and inflation impacts. Okay, and inflation impact. So we would always obviously be recommending it for the established businesses only and not other than established business. Makes sense, right? It's very logical. Okay, just now let's go forward. Now let's take up the next one, guys. Activity based budgeting. Right, I'm sure that you know about activity based costing, but even if you don't know, I'm going to take up activity based costing today, don't worry. So activity based budgeting is basically applied in those organizations that follow activity based costing for doing the valuation of their overheads and for including the overhead cost into the product cost. Okay, so the organizations that use ABC as the base, for them ABB applies. So what is ABB? Let's have a quick summary here. It applies cost information that is derived from the ABC. It is used for budget preparation and of course towards the overhead cost only. So cost information is used as the base for the budget. It helps to control the cost drivers. The same way that we apply ABC to overheads, we will apply ABB to the different budgeting heads. That's all. Okay, and entities, generally it is recommended for those entities where ABC is already adopted. Of course, logical. Okay, now I come to one of the core topics, that is ZBB, zero based budgeting. Zero based budgeting, one of the core topics for you. Why I say core topics? Because zero based budgeting is a very popular topic, and it basically says, boss, forget everything, you have to start from scratch. You have to do a question that why do you need a particular expense to be there in the budget. Do that questioning, do that reasoning, and then only include it in the budget. Okay, so no incremental, no top down, no bottom up. I mean, it is ZBB is simply that you validate every expenditure, revenue, everything from scratch. And we do apply ZBB. Situations when we apply ZBB is like when we do an budget for the non-current assets. So we don't say like last year we did investment in 1 million, so this time we'll do in 1.2 million. No, we see the relevance, that how much investment is really needed. Accordingly, we do that investment. Clear? Okay, so ZBB is starting from scratch, that is the zero level. Every expense or cost inclusion in the budget will require justification, and every calculation is fresh We don't work on the past data here. Very important. For ZBB, you don't work on the past data. Okay, I hope it is very clear. Okay, let's go further. Just give me 1 minute and then we go further into it. Okay, let's do this now. Now here, so ZBB is a method of budgeting where every expense must be justified. Boss, please don't forget this. ZBB is going to be there in your MCQs for sure. It can be MCQ, it can be section C question, but it is definitely going to be there. Have a strong hold of this. Okay, now please understand this process involves the key stages. The key stages, number one, define the objectives. It is very important. We have to determine the goals of the organization, the departmental goals, organization goals, because only when we know what are the targets to be achieved, we will be able to know the expenditures which are needed to achieve the targets. Number two, identify the decision units. Identify the decision units, that is basically now we divide the organization into multiple activities. Okay, and then we prepare a decision package for each of these activities. Okay, and that is known as the decision package or a budget package. So for each individual activity, I'll prepare a decision package. That is step number 3, create a decision package. Decision package just is basically a summary, like for every activity, what are the targets to be achieved? Okay, what are the alternative ways to achieve them, and what is the expected cost and benefits from it? So for every activity, it's kind of a justification that we are drawing, that what are the targets that you need to achieve, what are the costs that will go in achieving those targets, and what will be the benefits of the same. Now we will look into multiple different packages for a particular activity, and then we evaluate it, we rank it. Okay, and we choose the one which is more justifiable, simple, and which is more aligned with the organization goals. Clear? Finally, we will allocate resources towards those activities. And yes, and in these packages also we'll have two parts. One part of the package is very, very high priority package, and the other part of the package is where you have some add-ons that we say incremental package. I'll just take it in some time. So you have to, when we are allocating the resources, make sure that we allocate the resources mainly first to the priority packages, to the base package. Only then the add-ons that we are adding, no incremental and all, the discretionary cost that we can say, only then we will consider it. Otherwise, we will not consider it. Okay, so it's very important that first the priority or the requirement of the entity goals should be met. Next is review and approve. Once we have made the allocations, then approval of the budget is needed. Finally, you implement the budget, then you do the same thing. Monitor the performance, compare it with the actuals, and see what are the variances. So then the steps remain same, but the budget preparation is now by ZBB approach. So like I said, there are 3 decision packages that we focus on. First is the base package, next is the incremental package, and third incremental package 1, and then we can incremental package 2, incremental package 3, 4, so on. So this is a mandatory. These are the mandatory expense to be done. Now let me take one example to make you understand this quickly about how do we create a decision package. Okay, so now for example, an entity wants to launch a product. Now when an entity is looking to launch a product, marketing cost becomes a very, very major cost. Yes. Now here, let's say the base package is that minimal launch expenses should be incurred. That means, for example, we will have an email campaign, we will have a social media campaign, maybe a tie-up with a PR company can be there, samples distribution can be done. So it's a minimum, marketing that is needed to launch a product. And this is needed, mandatory needed this much marketing. So then what is this? This is my minimum level. And so it is my base package. Let's say one of the incremental packages, something that we can do over and above this, we can have the meta ads run. Okay, then I can hire even a bigger PR company to look, to maybe do more promotional activities for us. And we can hire an influencer, for example. So this can cost us some extra amount. But this is a discretionary amount, right? So this is the, in the marketing one, the base package was the minimum that has to be done. But now on top of it, we can go for first option, like I told you. Second option can be where we can, instead of hiring an influencer or maybe doing more social ads, we can hire a very big PR company that will do everything on our behalf. So this is incremental package 3. Now it is a choice with the business to either go for only base package or base plus incremental 1 or base plus incremental 2 or base plus both incremental packages. Okay, so that incremental package is a discretionary cost. So if the business can only do with the normal marketing cost, it can do with it. It doesn't need to add on more. So this is what is discussed here, that when we look into the ZBB approach, we will always look into what are the expenses that are needed, justifiable, and the discretionary expenses or the incremental package ones, how much should we take and how much should we leave. This is the entire summary of ZBB, guys, at one place. Tell me if you have a query. Now going towards the last portion of your budgeting systems. Yes, we're done with budgeting system revision. The last portion of your budgeting system is beyond budgeting. It says, boss, look beyond the normal budgets, look beyond the normal annual budgets, the traditional budgets that you are creating, because it's a changing environment. It's an AI environment. And every day your environments are changing. Okay, so then sticking just with the normal traditional budget would not do much benefit for the entity. So now what should the entity do? They should look at beyond the normal budgeting process. And what is the normal, but beyond the normal budgeting process? Is like, for example, use more adaptive business processes. Okay, use more adaptive management processes. For example, that we know we have to achieve the target. Okay, but now instead of just focusing on achieving the target, we may just focus on maybe providing some add-on services to the client, so that when the client comes to take those services, the targets are automatically achieved. For example, Country Delight, I'm just giving a simple example. Country Delight launched its milk initially, but then when it started with doing a lot of marketing, free samples, doing more of ads, but less of those ads, social media ads. Then it started thriving. Now when the good revenue was collected, it was got a good popularity. It started even doing more aggressive marketing by hiring more celebrities, influencers, and all. So now what happened? Its reach even got more widened. So it has to achieve a normal sales target, but now the way to achieve it has become different. Now it knows that it needs to achieve the target of milk, but then it has started selling more fruits, vegetables, and the other grocery items. Because if they know that if a person is coming on their website for a grocery or a fruit and vegetable, they may just end up buying milk also. So got it? So the ways of achieving it has become different. So it says that go beyond budget. Your target is not just to achieve sales, but your target is to ensure that the company looks at a larger picture and it is well welcomed, well perceived by the public at large. Another example that I would really like to give you is Ambani wedding. Okay, they have normal business targets, right? But why do you think they keep so lavish weddings? Popularity, their name, the fame in the world grows, which indirectly helps them in growing their sales. So they're not just going by the normal budgeting process. It's all the different processes that they have adopted, right? All of you agree to it? Please put up in the chat box. Yes, guys? Give me the input. How's it going? And I would like to ask a my favorite question. How's the Josh, guys? High or low? How's the Josh? Put it in the chat box. Come on, your Josh needs to be higher than my Josh. Okay, let's do this. Let's just take one question so that we are clear. Okay, let's try this simple question of rolling budget. Apex Limited uses a system of rolling budgets. The sales budget for the year to 31st December 20x3 is given to you. Okay, for quarter wise details are given. Actual sales for the quarter 1 has been 117,879. The adverse variance is explained because you can see the sales have gone down. The adverse variance is explained by the growth being lower than anticipated and the market being more competitive than before. Senior management has proposed a revised assumption for the sales growth to be 5% per quarter only. Okay, now what would be the forecast for quarter 4 sales? Now you know that you have to take the base as 117,879. With this you add 5%, you will get the quarter 2. Then add 5%, get quarter 3. Then add 5%, get quarter 4. Anybody would like to answer this? Put it in the chat box your answer. What is quarter 4 sales? But let me just work it out. Quarter 2, quarter 3 and quarter 4. So quarter 1 will be 117,879 multiplied by 105%. So that is 123,773. Now again we will add 105%. 123,773 multiplied by 105%. I get here 129962. Then with this also again I will add 5% and I get here 136460 approximately. Now is this there my answer? Yes. So my answer is C. So this is how we apply rolling budgets. I'm sure now you've got the hold of it. Okay, that's great. Now let's go to the next topic. The next topic that I will take up is variances. So I've taken budgets. Now I'm going to take up variances where I'll take up advanced variance and planning and operational variance both. So just focus on my screen for the same. Okay, so I'm taking up advanced variances and planning and operational variances. You have any questions and queries, you can ask me. Okay, guys, just give me 2 minutes. I will be there. Don't go anywhere, just 2 minutes. Okay, just 2 minutes. I'll be there and then we begin with this. Okay, now let's continue here. So we are doing advanced variances. I hope I'm visible. Just somebody tell me in the chat box, am I audible and visible properly? Just confirm this, please. I hope I'm audible properly. Okay, now let's proceed here. So now we are discussing advanced variances. Now, when I look at advanced variances, what is coming in your syllabus, in your PM, is only these two categories, material and sales. Now, I know some of you may ask me, ma'am, can you have a recap of basic variances? So don't worry, I already have a good video uploaded on my YouTube channel for the basic variances. I request you all to go through the basic variances video that I will upload. The link I will upload in the description box also. Please go through the same, and I'm sure you'll be clear with your basic variances. I am taking here right now. Thank you, Subarna. I'm here taking right now the advanced variances and the planning and operational variances. Now let's just have a quick look at here. Now, when I take up advanced variances, the first one I'm taking up is material variances. And the reason why do you call them advanced is because you're going deep dive into it. We know primarily material variances are the price variance and the material price variance and the usage variance. Now, you are further going deeper into the usage variance only and categorizing it further into material mix variance and material yield variance. Now let's see the logics again. What is a material mix variance and what is a material yield variance? Material mix variance, that simply says when you have multiple materials that went into the production process and your output is generated, you have a lower usage. Your standards, they suggested the material, sorry, do you have a higher usage? For example, your standard suggested that let's say the overall 200 kgs of material must be used, but actually you have used 500 kgs of material to produce the actual output. That means there is some problems here. So usage variance is just telling me that look, there are problems, that you have got a variance here, but where is the problem relating to? Is it relating to a lower quality of material, or is it relating to the mix that I've used wrongly? So that mix variance we will determine as the first one, where I'm just focusing on what should have been, the mix as per the standard mix, what should have been the inputs and for producing the actual output, and actually what is the input. Okay, sorry, my bad. I would just take, we are focusing on mixed variance. Mixed variance means you know the input which is there. So we will take actual input. Let's say my actual input is 1000 kgs. Because always remember, in variances only one variable is there. Not every factor is variable. So if you're looking only into mixed variance, only your mix is a variable point. Rest everything is constant. That means I will have my inputs fixed at, let's say, 1000 kgs. But now I need to see that what would be the difference if I use these inputs as per the actual mix, or if I use these inputs as per the standard mix. What would be the overall impact on the variance? My variance is going to increase or decrease? So that thing we will understand with the mix variance. Clear? Yield variance is the second one. Yield variance simply tells you that look, okay, fine, we assume the mix is as per the standard, because what is variable here is the yield variable. Okay, so we would assume that your mix are as per the standard. Clear? Your mix is as per the standard. But now we have to see that, okay, your input, you are saying actually you have used 1000 kgs. But to produce the actual output, ideally, what should be the input that should have been there as per the standard? Find out that. Keep both in the standard mix. Okay, keep both in the standard mix and then see the variance. So what will this help you? This will help you in understanding that what was the impact on the usage variance, which was adverse on account of the different mix that you followed, or what was the impact on account of the quantity difference that was there. Okay, mix was constant, but you had done wrong, more input rather than the input that was suggested as per the standard. So both when you combine, then we get the usage variance. I hope now the purpose and the implication is absolutely clear. So when even you have a theory question, you will be absolutely clear about it. Okay. Now let's go further. Now when I take up the sales variances here, sales variances again, the basic ones are sales price and sales volume variance. Okay. Now volume variance is further checked into sales quantity variance and sales mix variance. Again, mix variance is just like material mix. Here we see just because we are selling the quantities into different mix, the mix which is suggested by standard and the mix that we are selling actually them in, right? Just because I'm selling the quantities into different mix, what is the impact on the variance? Is the mix change having any impact, adverse or favorable? Check that. Second, because of the quantity difference between the actual and the budgets, what is the difference? Okay, when you combine these two, you get the volume variance. Clear? Absolutely. Let's look at them in detail. I will make you understand the performer in the most easiest way so that you don't have to learn it at all. Now look at my screen. So now we are discussing material mix variance. Guys, what is the focus on? Mix. My variable factor is mix. Don't forget that. So what I will do comparison with, because if your mix is variable, you know quantities will remain actuals, correct? So you will take first side, you will take what is the actual input and put it in actual mix. Compare with actual input in standard mix. Done. Get the variance. Multiply it with standard cost per kg, because that's what we always use in all the variances. Standard cost per kg and get the variance. Simple, easy. If difficulties, you can tell me. Now I take up material yield variance. Now look at the pointer. What is the variable point? The variable point is yield. Very good. The variable point is yield, my friends. When variable point is yield, what does it suggest? That now you have to take the difference between the yield. Yield means quantity. So you will take the difference between, if we produce the goods in standard mix only, what should have been the input to produce the actual output? To produce the actual output, ideally what should have been the input if we use the material in standard mix only? Number two, what is the output that we have actually what is the input that we have actually used to produce the output? Right? Now you compare between the two and multiply them with the standard cost per kg and you get your yield variance. Clear? Focus always on the term, what is asked in the exam. Even in the basic variances also, always remember there is only one variable. Your cost will always be standard. It will never be actual that you will multiply with. Number 1 point. Quantity, wherever you will take, you will always take actuals and never standard. Done. So these two assumptions, remember, and the logic that I've told you, you will never be mixed up with the variances. Even today, I do variances in the same way, even in my office work. Okay, clear? Now there is one more method. This method, that is a tabular method, which I just told you, it is known as the input method because we focused on the inputs comparison, right? The second method is output method. Output method is also, it is an option to the student to follow either the input or the output method unless specifically asked by the examiner. So you need to know both the methods. Output method means what? It is not difficult. It's the opposite of input. We know what is the actual output. Now, if we apply the standard mixes, then ideally what should have been the output? Considering the input, what should have been the output? Clear? What should have been the output? Now we compare between the output as per the standards and output as per the actuals. Now since we have multiple products, I cannot just multiply with weighted cost per kg because which material cost I will take. So I cannot simply multiply it with standard cost per kg because I don't know which material cost to take. So when you have multiple materials, and what you will do, take weighted average. Very good. So what you will do, get the total and divide it by the total quantity, and you will get your total cost or the weighted average cost for the all the materials taken together. Multiply this with weighted average cost. So remember, in output method you have to multiply with weighted average because you have to take kind of an average of all the three rates. Clear? Okay, I can take up a quick question here for understanding, but just tell me quickly, guys, do we have clarity of variances now? Is material mix, material yield now clearer to you, to all those who may be having these queries with them for long? Do we have clarity? Type in yes or no. Guys, do we have clarity? Okay, let's see the question and then you all type in. Then you all type in just as a reply to me that yes ma'am it is clear, or no ma'am I'm still in the doubtful range. Tell me that. Okay. Now let's see the questions, and the standard details are given to you for 1 unit. Okay, I've taken this customized question. Material X is 2 kgs that we require to make 1 unit of output, and the cost is 3. Thank you, Subarna. Okay. Others also, my friends, you're free to revert. Now, material X we require 2 kgs to make 1 unit, and the cost of material X is $3 per kg. Material Y we require 1 kg to make 1 unit, and the cost is 2 per kg. Total cost I have given you, total quantity I have given you. Now the question is, further details are given to you. Actual production is 5,000 units, and the material that we use, material to be used are material X. Actual quantity is 9,900 kgs that is used, costing 27,000. Material Y 5,300 kgs costing 11,000. Done. Now first let's calculate the basic variance. So here you have a recap of your basic variance also, which is material price variance. Let's do the calculation. What is material price variance? Variable is price. So get the difference between standard price and actual price, multiply with actual quantity. Because quantity we always take actual, cost we always take standard. This is the kind of a default thing that you will carry. Now, so material price variance will be, what is the standard cost is 8. For we will do it for every material. Material X standard cost is 6, material Y standard cost is 2, and overall, okay, no, we'll compare it between the kgs. So yeah, so make it very easy. Material X standard cost is 3 per kg, material Y standard cost is 2 per kg, because we will multiply it with the number of actual kgs, right? Material is measured in quantity, kgs. So what is the total standard cost that we have? 3 multiplied by actual kgs. Actual kgs are 9,900. Why I'm doing it this way? Because I already have the actual cost with me. So make it simple. So I'll do 3 multiplied by 9,900 and 2 multiplied by 5,300. When you multiply it, you get your standard cost, that we also call as absorbed cost, as 29,700 and 10,600. Now from this I will reduce my actuals and get the variance. If your actual is less, it's favorable because you're spending less. If your actuals are more, it's adverse because you're spending more of the entity's money. So when you see this, you get a favorable variance of 2,300 net. Let's see usage variance. Again, the focus is on usage, not the price. So cost we will keep same as standard, but now the material that has gone in, that we will compare. First, what is the material required to make the actual units, and then compare it with the actual kgs. Okay. So for material X is 2 kgs are required to make 1 unit, correct? We require 2 kgs to make 1 unit, and total units required are 5,000. So material X ideally is required 10,000, but we have used 9,900. So it's a favorable thing, no? We have a favorable variance. Material Y, we require 1 kg to make 1 unit. Total 5,000 units are to be made. So we have 5,000 kgs. Actually, we have used standard set to use 5,300. We have used less. It's a favorable variance. No, actual is more. Sorry, my bad. This is not standard. Standard says to use only 5,000 kgs. We have used 5,300 kgs. Since we have used more, it's an adverse variance. Okay, and then you reduce it. Finally, you get your 300 adverse variance. Okay, so material price, material usage is clear. Let's go to the material advanced variances. Let's calculate material mix variance. So now you will prepare the table. First, you will have the column for actual units means actual mix. Standard units as standard kgs in standard. Okay, actual kgs in actual mix, actual kgs in standard mix. Clear? This is how we'll have it because here the variable is mix. So you have to focus only on mix and nothing else. So you will keep your quantities same as actuals. Now what are the actual kgs? Total actual kgs are 9900 plus 5300, which is 15,200. Now you put it in the actual mix. Now you put this 15,200 in the standard mix. Standard mix means material X mix is 2 by 3, material Y mix is 1 by 3. Clear? In this proportion you allocate it. Done. Get the difference multiplied with standard cost per kg. Standard cost per kg is 3 and 2. So multiply with 3 and 2 and get your values. Done. You will get your variance. Clear? Now let's look into this material yield variance. First I'm doing it by input method, then I will do it by output method. When you do input method for material yield variance, now understand your mix is constant. So you will keep standard mix always. What is variable is the input quantities. First, you already know your actual inputs, which are 15,200. Put this in the standard mix because this is the by default mix we take. Second, now you take that in order to make the actual units of 5,000, ideally what is the standard kgs needed? We know that we require 3 kgs of X to make 1 unit of Y and 2 kgs of Y to make 1 unit of actual unit. So 3 into 2 is 3 into 5 is 15,000 and 2 into no, not 3 per kg, sorry. We need 2 kgs of material X to make 1 unit So total quantity needed for material X is how much? 2 into 5, 10,000. Clear? We need material Y 1 kg to make the final unit. So material Y 1 into 5,000. 5,000. 10 into 5, 10 plus 5 is 15,000. Now we know as per the standards, ideally we should have used only 15,000 kgs. Only 15,000. But we have used more kgs, so it's an adverse variance. Now again take the variance multiplied with standard cost per kg and get your answer. So easy. Let's do it by output method. Output method says go reverse. So please see what is your actual output. So actual output is 5,000 units. Now you know as per the standard we would require 15,000 kgs. But this I don't need here. When we see output method, you will take actual input. Correct. What is your actual input? 15,200. Okay, now put this in the standard mix. As per the standard mix, 15,200 is the total quantity of our input. Correct. 1 unit requires, as per the standard, 1 unit will require 3 kgs. Correct. Of the total material, 1 unit will require 3 kgs of the total material. Now divide 15,200 by 3 and you will get tentatively with this actual input and the standard mix, what would be the output that should have been there. So as per this ratio, my output should have been there as 5067 units. But we have manufactured lower units. Since you manufactured lower units, so now what it is? Adverse variance. Remember, whether you do input method or output method, your answer would be same. And the total of mix variance and the yield variance will give you the usage variance. Done? Clear? Any question, doubts? Please put it in the chat box. Okay, I've given some questions also here. Okay, that's okay. Okay, now I'll take up a question for sales variances so that we understand the sales variance also quite clearly. Now look here. Let's see the question here, guys. Products are sold are PQR and the details are as follows. What are the details given here? The details given here are the standard proportion is 25%, 50% and 25%. The budgeted units are this. The standard price per kg is this. standard contribution per unit, standard price per unit, because it's a material, right? So standard price per unit is this, and the standard contribution per unit is given to you. Clear? Now actual units and actual selling price is also given. Boss, I don't need actual selling price anywhere except when we calculate the sales price variance. We don't need it anywhere. Clear? Remember this. Remember these pointers. Now, when I take up sales mix variance, let's do the calculations. So when I take up sales mix variance, what is my focus point? Mix. Keep the quantities actual and keep the mix different. That's all. Actual quantities are, get the total, you get here 500. So now actual quantity is 500. You will keep your units same. Now put 500 in the actual mix, which is already given to you, and put this 500 in the standard mix, which I have given here, 25, 50 and 25%. Done. Now you will do it in the actual quantities in the standard mix. Take the variance, multiply it with the standard contribution per unit. Why? Because either you take standard contribution or you take standard profit, depending upon the environment, absorption or marginal, or whatever is data given to you in the question. Here the question gives me contribution, I'll take contribution. So practically the actual price and standard price you will only take when you are doing price variance. Otherwise you will never take these figures anywhere in the sales variances. Clear? Okay, now you multiply with standard contribution, get the variance. Done and dusted. Let's do the second one. Sales quantity variance. Now, what is your focus point, guys? I want always you all to look at your focus point. Your focus point is quantity. That means my mix is not a variable here. So keep your mix same. When you have to keep the mix constant, what you use? Actual or standard? Standards. Clear? So you will put your quantities in standard. But now here the difference is on quantity variance. So take actual quantity in standard mix and budgeted quantity in standard mix. Okay. So my standard mix actual quantities we have already worked out here that you will take, and budgeted quantity is already given to you, and the standard mix in which it is there is also given to you. So use this budgeted quantity. Done. Now you will have a difference here. So it will give rise to variances, and accordingly calculate the variance, and the contribution will remain same in both the cases. Done. Clear? This is how you will get your sales quantity variance and sales mix variance. That's all. Any questions anybody has, you can put up in the chat box. We are done with advanced variances. So all those who tell me, no ma'am, it's very difficult to have advanced variances, I'm sure now you are clear that yes, advanced variances are not troubling at all. Just a minute, I'll start with the planning and operational variances. Okay, now we're looking at the next one. Planning and operational variances. Very important. Again, see, it is a topic that is always going to be there. See, variances are going to be there. Okay, always going to be there. Clear? Now, planning and operational variances, let's quickly have a look at it. First, let me give you the basics that you will never forget, and then you will never forget these variances only, and they become like very easy for you. Boss, I will tell the manager that, manager, look, you have done a terrible job. Your variances are all adverse and I am not going to give you any bonus. Manager will say, boss, it's not my mistake. It's because the management set a very high target. A very high target. Okay, that management has set a very high target. So I really don't think that, this was achievable. So then management thinks, okay, is it really the problem of the management? Okay, let me check. So what they do is they divide these variances and they say that, okay, you think that you have a variance? Yes, I have a material price variance of 1000. Now let me see how much of this variance is actually due to a fault by the management, because they set the standards pretty high. or is it actually due to the work that was not done properly as it should have been? So then how would we calculate the planning variance? And then comes the 2 pointers. Yes, planning and operational variance. So you can calculate planning and operational variance for all the variances that you have, all, right? Typically we do it for certain variances only, but you can do it for all. Logically clear? So now comes the next point, ma'am. How do we calculate planning variance? Plans means what? Budget or actuals? Budgets. So where is the management going wrong? Because originally they fixed a particular budget, 100. Then they revised it because the terms and the situations changed, and we got a revised budgeted figure of 60. Now, what was the target given to the production people to produce? 60, right? The revised budgeted target. So they did everything relating to 60. Clear? No. The production people were always given the target that was given in the original budget. That was 100 units. They were told that, look, you do 100 units. Okay, so they worked according to 100 units, and in between the budgets got revised. So now we have to see that due to the revision that took place, okay, what was the impact on the budget? The original budget and the revised budget. This difference, that is the planning variance, because it's all relating to the planners. Planners are the one who deal with budgets. So original and the revised budget difference, planning variance, and revised budget and the actuals difference is your operational variance. So typically what we see at is that what is the impact of the variances on account of the mistake done by the planners and on account of the mistakes or the work, the inefficiency at the end of operations. Clear? So this is the main logic of planning and operation variance. So any variance that you have, you can divide it into this. Just that the data should be made available to you. Okay, now look at the scenarios. So now when I say planning variance and operational variance, it's a good chart that I've got. Right? Okay, looks so colorful. Now look here. The planning phase, if I see, planning phase relates to forecasting of budgets, standards, assumptions, planning targets, and the expected performance. So planning variance means what? You are taking basically a budget variance. Okay, you are basically considering a budget variance. Clear? Now how do you calculate planning variance? Let's quickly have a look. So here I take the difference between original budgeted figure and the revised budgeted figure. Clear? Now this is because we will now say that, okay, planners, you are to be blamed, you gave us this wrong budget. Now when I see operational budget, here we focus on actual performance, actual cost, and the real outcomes are here. So here the focus is on actual performance, right? So here this is also known as the market variance or the market share. I'll come to that, market share and market size. I'll come to that. Now, so what are the operational variance? The difference between, it is a difference between revised variance, revised budgeted figure, and actual budgeted figure. Clear? So we get the difference between revised and actual budgeted figure. Absolutely clear. I'm sure you guys have hold of. Right? Now, so here I'm just summarizing. Planning variance is simply a difference between original budget and revised budget, and operational variance is a difference between revised budget and actuals. Now let's say you calculate material price or labor rate variance. In both these cases, you will have the same treatment. So how would you calculate a planning variance, guys? I'm sure now you know that we will take what is the actual quantity and we will take the original budgeted price. Then we will compare it with actual quantity and revised budgeted price. This is how I'll get planning variance. Now how will I determine it's an adverse or a favorable? Logical, like we do for original and actuals. If your revised budget is more than the standard original one, it is an adverse variance because now it is actually costing more to the entity and it is more than what the budget was originally expecting. If your revised budget is less than the actual original budget, then you know it's a favorable variance because now the situations have improved. So ideally it's going to cost less. When it's going to cost less, it's a saving for the entity. So if we go by the same trend, then the actuals will also cost less. Clear? Now, when we look at the operational variance, we take the difference between actual quantity, that is always going to be actual, because here my variable is price variance. Understand? Price or labor rate. So everything else remains constant, like the cost and the quantities. So here I'm taking the difference between revised standard price and actual price multiplied by actual quantity. How would you determine it's an adverse or a favorable variance? If your actual price is less than the revised standard price, it's a favorable variance because actually you're saving for the entity. If your actual price is more than the revised budgeted quantity, it's actually an adverse variance. Clear? Likewise, we can have a material usage, which is all, or on the same lines, we can have a labor efficiency variance. Same calculations, and labor efficiency, instead of kgs, you will use hours. Now, how do you calculate the planning variance? Here, the focus point is usage. Usage means standard quantity to make, standard input to make actual quantity, correct? So here, what is the original standard quantity for actual output? And what is the revised standard quantity for actual output? So you would always take the difference between standards, because yes, here we are focusing on budget. Okay, and multiply it with the original standard cost per kg. This is a very important point. I've seen students to be confused that when we do the planning and operational variance, no, they take for operational variance revised budgeted figure for the standard cost per kg, because they see that the comparison between revised and actuals. So they take the revised cost per kg. But my friends, I've told you always that this is going to be like rock solid. You will always multiply it with original standard cost per kg only. You will never take revised. Revised is only for quantities and nothing else. Clear? So if your revised standard quantity is more than the budget, it's an adverse variance. Why? It is going to cost more for the entity to use more kgs. Likewise, when I do operational variance, I will compare between revised standard quantity for actual output and actual input for actual output. Clear? Now you take the difference and multiply it with original standard cost per kg and get the operational variance. If actually you are using more quantity, it's an adverse variance. If actually you are using less quantity, it's a favorable variance. Done and dusted? Clear? Okay, any questions? You have to put it in the chat box. And after this, it's a compulsory point that I want from all of you, that are the variances absolutely crystal clear? 100% you have to tell me that. Now, when we see the sales variances, guys, then we have again, here I am looking more into sales volume variance. On the same lines, you can do sales price variance also, same. Now here the focus is, what do you call these planning and operational variances? Confusions? No confusions needed. Planning variances are termed as market size variance, and the operational variances are termed as market share variance. Size and share, remember. Why? Size, you always remember it as a larger picture. So it is based on external factors. Share is a lesser picture. It is based on internal factors. Correct? Now, when we see market size variance, now if you have to calculate market size, question comes in, ma'am, sometimes we have the market size given and we're not able to calculate what is the market share, or how do you calculate the entity share? Should we work it out on the budgeted unit, on the budgeted market size, or the actual market size? What should we do? So here is the solution. Look here. Now, how do you calculate market size variance? Market size variance is calculated as actual market size, because it's a planning variance, right? No, I'll just correct this formula. There's a mistake. Look here. How do you calculate a market size variance. Okay, how do you calculate this? So you will simply take the difference between original standard quantity less revised budgeted quantity, right? That we take. Now, if you have to calculate revised budgeted quantity, that I always find students to be asking me, ma'am, how do we calculate this? Simply what you will do, you will take actual market size and you will multiply it with the revised market size share. The question tells you that originally the market share was 20%, then it got revised to 30%. So now you will calculate 30% on the actual market size and not the budgeted market size. Okay, that's very important point to note. So now you get the difference between original standard quantity and budgeted standard quantity very easy, and now you will multiply it with what? The normal rule that we do. The original standard contribution or profit per unit. Okay, original standard contribution or profit per unit, that is the standard way that we use, and only with that you will multiply. So I hope I'm very, very clear how to calculate the market size variance. Okay, now what is actual market size? Actual market size is the total actual units in the market. Budgeted or planned market size is expected sales units in the market. Budgeted market share is a percentage of the market that the company is expecting, and budgeted selling price per unit is the planned selling price per unit. But here we will not take it. Here I will take budgeted profit per unit or the budgeted contribution per unit. Done? Clear? Okay, let's proceed further. Now I'll take up market share variance. So here also I'll just make the change. And market share variances, you will take the difference between actual sales quantity okay, you will get the difference between actual sales quantity less you will do revised budgeted quantity and multiply it with original standard contribution per unit or profit, as the case may be. Okay, original standard contribution or profit per unit, that you will do. Clear? Done? And you will get your variance. So if your actual quantities are more than the budget, it's a favorable variance. Actual quantity is less than the budget, then it's an adverse variance. Clear? Okay, let's look at one question. No. Okay, done. So we are done with the variances. Now come on, quickly tell me. I hope that everybody is absolutely crystal clear with this, with the understanding of the planning and operational variance, the budgets, the budgetary systems, and the advanced variances. So if I just look at the list, guys, so far we have completed budgets, we have completed variances completely. Now I would be taking up performance analysis and measurement, and only then, and divisional performance and transfer pricing. First I'll be taking these two, only then we take the remaining two topics of ABC and data information and analytics. But I think now it's the time that we can have a quick break. So let's have a quick break of 5 minutes, and post which we will be doing divisional performance and transfer pricing. First, I will be taking transfer pricing, and then I will be taking the performance analysis and measurement, where I'll take a building block model, tips to ensure that you remember them correctly, and the balance scorecard and other methods. Okay, ROI, RI, all that I will take. So let's have a quick 5 minutes break, and first we will take it. So I think break will give you some energy levels. Keep your energy levels high, keep your activeness high, and be there in the class. Okay, let's have a quick break. Yes. So I hope everybody is there and you guys are refreshed from the break. Right, now let's start discussing divisional performance and transfer pricing. Very, very important topic. You will say, ma'am, every topic that you are saying is important only. Of course. Of course, all of these topics are highly important. So let's cover them. Just 1 minute. Just give me a minute. I'll just open that file. Okay, apologies for the break. Right, now let's start doing this. So now I am discussing the next chapter, which is divisional performance and transfer pricing. I know I call every chapter as important because in ACCA, the beauty of ACCA is that from every nick and corner you will find questions. So there is nothing like important actually as important. Okay, but then there are some chapters that have always been asked for the asked in the exam, and transfer pricing typically is a hot favorite for section C. Okay, generally in one of the sets, in one of the question papers, we find transfer pricing to be always there for us. Okay, now let's understand this in detail. So when I look into detail of divisional performance, so divisional performance here we are basically looking into the performance analysis for the different divisions. That typically means that if let's say there are division A, division B, division C, division D, how would the managers of divisions performances be evaluated? Okay, so the purpose is here to look into the managers performance evaluation, and as such for managers also there, what is their evaluation criteria when they evaluate the performance of their divisions. Like, and the question comes in, like for example there is a new project, so whether they would be really be accepting that project by only looking into the division's performance point of view or not. So that also we are going to answer. Look at my screen. Now, first thing that comes up is decentralization. That is here the organizations always look for creation of these autonomous or independent units to decentralize the authority and responsibility. Now, the different cost centers that an organization can have, or the different you can say evaluation centers for an organization are. So we can categorize the divisions into revenue centers, We can categorize them as revenue centers or cost centers or profit centers or investment centers. There is example given here, but I'll just quickly tell you about it in a summary. Revenue center means what? Those centers, those divisions whose primary responsibility is towards selling of goods. So their performance evaluation is technically only on the basis of the goods that they've sold, or they are targeting to sell. What is their performance with regard to that? Revenue generation. Then there are some departments who are not directly relating to revenue generation, but they are like a support system towards revenue generation. So they are evaluated on their performance because they are more like cost centers, as they are, yes, contributing more towards the cost of the entity, of course, and they are treated as a support system there. Now, third one is the profit center. Profit center is basically those departments, those divisions which are normally working as a profit center. That means like a plant for a company, like a complete, you can say a franchisee for a company. Okay, or basically a complete plant, a complete factory for a company, wherein a branch of an entity which is capable of selling the goods, which is capable of incurring costs, so therefore it will be always evaluated for its performance on the basis of profit generation that they have done. Next one is investment centers, so like the corporate office of an entity or the entire company, only a smaller company wherein all the activities of sale, purchases, investments, they take place. So when I say investment centers, they are not answerable towards the investment decisions, but they are also answerable towards the sales that have been made, costs that have been done, profits that have been generated. So it's like a comprehensive, everything is included in investment center. Yes, every company, every corporation is an investment center for sure. Now, revenue centers example, sales office. Cost center example can be accounting department, HR, admin, and so on. Profit centers are like the plant of a manufacturing entity. Investment centers are like the companies and the corporation itself. Now, in order to measure the performance of a division or an entity, remember there are three main important factors that we consider. Goal congruence. Goal congruence simply means that what is the goals of an entity should be the same goals for a division, but that is where the problem comes in. I'll give you a reason. Here I've given you an example. Let's say the ROI, the return on investment of a division is 10%. The return on investment of the entire entity is 7%. Now, if a new project comes to division A and that is generating an ROI of 8%, it is beneficial for the entity, but will it be beneficial for the division when they are just looking into their own divisional profits? No. So the manager would say, look, I would not accept this project. Why? Because it is not fruitful for me. So why should I accept it? They would reject it. Even though now here, do you see goal congruence? No, because even though it is beneficial for the entity, but the manager does not feel it beneficial. So because manager knows that his performance will be evaluated based on the ROIs which is generated. So in case if he accepts a project with a lower ROI, his overall ROI will go down, and so he may be just penalized. Bonus may not be there, increments may not be there, rewards may not be there. Clear? Okay. Now, the second goal is long-term and short-term objectives. So typically when we see the divisional profits, ROI, it's more from a short-termism point of view. Long-termism is to look into the goal congruence perspective, right? So here the aim is to achieve the quarterly targets, yearly targets, and so on. Now the next one, accountability for the areas that they can manage. Ideally, they should only be accountable for that. So here we always talk about controllable profits. We always talk about controllable investments. The investments or the profits which are in the control of the manager. Okay, so that they should only be evaluated for the profits, for the investments that they're actually able to control, rather than looking into the entire perspective. Okay, now here. So here I will use the term, and you will also find it in your exam questions. These two terms must have found out in your notes as well. There are two terms that we say, controllable profits and traceable profits. So comes the point, ma'am, what are controllable profits and what are traceable profits? Controllable profits, my friends, they are those profits that are under the direct supervision of the manager, under the direct control of the manager, the decision of which can be taken by the manager. For example, the expenses include the expenses which directly are, you can say that they are directly related to the entity, and number two are and not, I will not say directly related to the entity, but they are the specific cost of the entity which the division is incurring itself. Specific cost of the division that the division is incurring. Now it also receives a share of expenses allocated from head office. Yes, it is the expense of the entity of the division only. Definitely, it is the expense of the division. But now it is allocated from the head office. Does the manager have any control over it? No. So is it controllable? No. So controllable profit is the manager's performance should only be assessed on the basis of the profit that he or she can control. Clear? Traceable profits are those profits or cost, those areas of cost and sales that can be directly traced to the division. That can be directly traced to the division. What does it mean? Please look here. So important is to look at this performer. So the performer to arrive at the divisional or the operating profit is number one, calculate controllable profit for the division. With this, you will add the allocation of head office cost, head office revenue and all. So you will arrive at traceable profit. No, I'm sorry. When you add the head office division, then you will arrive at total profit. But first we have to do traceable profit. So with the controllable profit, you will add the uncontrollable profit of the division. Uncontrollable profit means what? Those profit areas which are not under the direct control of the manager. Okay, and so you will add that area, and then when you add the two, you will get your traceable profit. These two terms are very important: controllable profit and traceable profit. With the traceable profit, so basically traceable profit is that profit that is directly traced to the division, directly traced to the division. Of course, in these direct profit and cost in the revenue areas, you will have expenses and costs which are not under the control of the manager. Maybe the purchase price, for example, the raw material cost. Raw material cost is all market driven, for example. Then it is not controlled by the manager. So then it will be part of that uncontrollable area. Clear? When you, with the traceable profit, when you add the expenses or the revenue which is allocated by the head office to the department, to the division, then it becomes total profits or divisional profit. Then we call it as divisional profit. Okay, because allocated head office cost or revenue, it is not a part of the traceable profit, right? It is not traced to the division directly. Hence, we add them later on and we call them as divisional operating profit. Clear, 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 great. Now I'll come to the next pointer, which is investment decisions. So when we come to investment decisions for the investment centers, very important to understand the two basic investment criteria, the two basic testing criteria. One is return on investment and other is return on, the other is residual income. Let's understand return on investment. Return on investment is just like return on capital employed, same way. So it is the division or the entity. What is the return earned by them? So it is the division or the entity return earned on the investment in the capital employed. So here we don't say just the return on the capital employed. It's a divisional return on the capital employed. So you will take your profit before interest and tax divided by capital employed, capital invested multiplied by 100. But remember, when we evaluate the performance of the managers, very important, when you evaluate the performance of the managers, it is very important for you to take only controllable profit, because that's the most perfect one, right? So we'll have controllable profit divided by capital employed multiplied by 100. Clear? If you want to take traceable profit, or if you want to, let's say, calculate divisional profit, then you will take traceable profit by capital employed into 100. So the question is, ma'am, what are we looking for? Are we looking for to calculate the controllable profit or divisional profit? Remember, when you're doing divisional profit, you will always take traceable profit here. Clear? Very important. Good. Now, the project would always be accepted if the return on investment is more than the cost of capital. And it basically means that the entity is doing well. Okay, so now here you would always go with that project that will give you return on investment more than the cost of capital. Now, understand, when you are comparing the two projects and you take ROI as the base, what is the benefit? It is giving you the answers in percentage form, right? So the comparison becomes convenient. But the negative point is goal congruence can be missing, like I gave you the example for. Please remember these advantages and disadvantages. They are very popularly asked in exam. Now the next one, residual income. Residual income, what does it represent? It represents the wealth which is created by the division or the projected wealth, okay, or the which is created by the division. How do you calculate? So residual income is a leftover income, that simply we say, and it is more better yardstick than ROI. Remember it. Yes, when ROI can give you the results which are not goal congruent, residual income will never give you those results. But the disadvantage of residual income is it cannot be expressed in the form of percentage. It can only be expressed in absolute terms. So that's the only disadvantage. How do you calculate it? We will take the profit, and generally, yeah, here also we take the controllable profit or traceable profit as per the requirement. So take controllable profit from it, reduce the notional cost of capital multiplied by capital employed. Why notional? Just to give an idea about whether the return or the profit is able to cover the cost on the capital or not. Clear? Once you do that, you will get your residual income. So the baseline is very simple. If your residual income is positive, accept the project. Residual income is negative, reject the project. That's all. It doesn't matter how much is your residual income, what is the standard residual income, there is nothing like this. Because on ROI, we compare the percentage with the divisional percentage. RI life is very simple. Accept the project with positive RI, reject the project with negative RI. Clear? So you will always calculate RI as the controllable profit less cost of capital on the capital employed, or we also call it as notional cost of capital or imputed cost of capital multiplied by capital employed. If you're evaluating division's performance, then I will take traceable profits. That's the only difference. Done? Clear? So ROI, RI, I hope are absolutely crystal clear. Now let's go to the next one, which is transfer pricing. So when I take transfer pricing here, what is transfer pricing all about? Transfer pricing is typically about when there are multiple divisions within the entity. So when an entity transfers any goods, sells goods, for example, between one division to another, it's interdivisional transfers that have taken place. Of course, every division would like to maximize its revenue and minimize the cost. But now we have to look from the entity point of view. So we are here trying to understand what is the most optimum transfer price, or what are the different transfer prices, the price at which the goods can be transferred from one division to another. First suggested is the simple one. Simple one means what is the best, that is both the entities would readily accept, is to transfer them at market price. Okay, you are selling to an external customer or you sell to an internal customer, doesn't matter, you sell it at market price. The only saving here would be technically, generally in your answers, would be transportation cost. Of course, if the internal divisions can transfer at zero in transportation cost or at reduced transportation cost, that can technically be a saving here. So remember this point. Full cost, let's say another transfer price offered is full cost, both would be ready to, okay, both, though the selling division may not have much of the much of the inclination towards this, because there are no profits which are covered, but when they have a lot of spare capacity, then they would be happy to do it. At least they're covering the full cost, and the buying division would be ready to buy because it will be lower than the market price. Clear? Let's go to the next one, marginal costing. So typically in your exam, when we have spare cost, spare capacity, we would like to do this as an optimal pricing, wherein we would transfer the goods at variable cost. Because here, from the entity point of view, at least when they have spare capacity, what is the only cost that they are getting? Assuming that they're just working till the capacity levels only, so fixed cost is practically not incurred additionally, right? So what is the only cost that they are incurring? Variable cost. So division A would generally not be very happy to sell at variable cost, because it's the minimum price that they would get, Division B will be more than happy. It's kind of the minimum cost below which they will never be able to buy. So they would always be happy to buy it. Now, full cost plus margin approach, again, you can just cover it, full cost plus margin, variable cost plus margin at the same lines. I will now come to one more cost, which is HO directed, generally both the divisions would not be really happy to buy at this price, because it's a very dictated price. So both of them would want their own autonomy, own fixation of prices. So this would generally not be well accepted by any of them. Last is the opportunity cost method, which is highly important, and of course you will find question on opportunity cost. Let me make it very, very clear to you, crystal clear to you guys, so that in the exam when you have the transfer pricing topics, this is not something that is going to haunt you. Okay, now first thing, when we take opportunity cost method, what is the main rationale behind it? What we have been studying always, that opportunity cost method will typically arise when the division is not working at any spare capacity. Spare capacity would mean that they would have only variable cost to be incurred, correct? When they are working at full capacity, then opportunity cost method becomes a very crucial method. And then comes the point that what is the minimum price below which selling division will not be ready to sell. And for buying division, what is that maximum price beyond which they will never be ready to buy? So we have to find out that here. Okay. Minimum price that the selling division would be needing, below which they will never be selling, is variable cost plus opportunity cost, right? Because they are not going for the next best alternative. So they are losing that contribution. So they would require that. But how to calculate it is a bit different here. For that, I need attention on my screen. Okay, now next is the buying division will not be ready to buy beyond this price. And which is that price? This is either the external price, that is, as it is, they are able to buy from the market. So either that price, or listen to me very carefully, or the net selling price at which they would be able to sell to the customer. So division B would say that, boss, I can buy it from the market at 100. So why would I pay you more than this? So they will never pay beyond this, or the net selling price that they are charging to the customer. How to calculate net selling price? I will tell you. Whichever is lower. Okay, whichever is lower, that would be the maximum price beyond which they will never be ready to buy. Never. Okay, what is net selling price? What is the effective cost to the division B? The cost that they are incurring, correct? They are their own variable cost. So net selling price is the selling price where they are charging to the customer less the cost which is borne by the buying division only, not the selling division. The cost which is borne by the buying division, you reduce it from it is the additional cost. I will write here less the additional cost. Okay, less the additional cost that the division B is incurring. For example, they are doing some remodifications, some repacking and all. So these additional costs that they are incurring, division B is incurring, only that cost you will reduce from the selling price that they are charging from the final customer. Okay, and then they will get net selling price. So either that price or the external price at which they would be ready to buy this material from the market. Okay, whichever is lower is the maximum price beyond which they would say, boss, I would never be ready to buy from the division A. Done. Now this is very important. Division A is very important, and I need that attention completely on my screen. No lose of that. Okay, so what is it? That, ma'am, variable cost we know. What is the variable cost for division A that you can calculate? I know. Question is, how would you calculate opportunity cost? I'll tell you why. Let's say division A would require 4 hours to make and sell the goods to the external customer. 4 hours. But now since they cannot sell these goods to the external customer, they will have to sell it to division B. But the good that division B requires will be made in 6 hours. So now can you see the difference? They are losing a contribution per hour that you can calculate from division A. That they are losing, let's say, contribution of 80 per hour because they are not going ahead with the external customer, they are going ahead with division B. That is, but for how many hours will you take it? For 4 hours that they required for external customers, or for 6 hours that division B needs? Of course, for 6 hours. Common mistake by the students is they will take contribution per hour of division A and multiply it with 4 hours that they need for external customers. No, my friend, because they need more hours for division B. More hours means more contribution lost. So here, how would you calculate opportunity cost? Opportunity cost will be Hours to be taken to produce the good to be transferred to buying division. 6 hours in my example, and multiply it with contribution per hour of the product when demand is sacrificed or production is sacrificed. So division A is losing 1080 per hour, 80 per hour for not selling to the external customer. But when we multiply it with the number of hours, I will not multiply with 4 hours that division A will take to sell to external customer, but with 6 hours that division B will require to manufacture that product. Because for every hour they're losing 80, right? For 6 hours that goes in division B, they're losing 6 into 80, 480. Clear? I hope now it's absolutely clear. Just comment quickly in the chat box. Is everybody clear with transfer pricing? Any questions, any doubts? Please tell me. Don't lose your energy levels, guys. Any questions, any doubts? Please tell me. In the chat box, any queries, any questions that you have? Okay, now let's go forward and let's discuss the next topic, which is again a very important topic, performance measurement. Typically, here what is more important is not ratios. What is important is you should apply the ratios in the correct way in your exam. When you have questions wherein you are asked to do a divisional performance measurement, you need these ratios to do the performance measurement. You need balance scorecard to do the performance measurement. You need building scorecard, building block model to do that. Okay, so let's understand it thoroughly and simply, and let's do the ratio analysis first. Okay, look at my screen. So when we are doing the performance measurement of the entity as a whole, this is the performance hierarchy that we have. I know we have covered it earlier. Let's just revise it. Because yes, 2 marks, even if it is asked for in the exam, why to lose it, right? So performance hierarchy is first step, it's a mission that an entity creates. Step 2 is corporate objectives, or for the shareholders' perspective, the corporate objectives are created by the entity. Third step is when the secondary objectives or the period-wise objectives are set, which is like the annual budgets or the targets. The fourth one is now you have even more decentralized objectives, which is like the unit objectives, where we set the objectives for the departments, for the divisions as a whole. Clear? Absolutely great. Now let's go further. So what is important for when we measure the performance of a division, of a unit, of the entity, is not just to look into the financial performance indicators, but also to look into the non-financial performance indicators. Financial performance indicators are like how's the sales of the entity, how's the profit levels, how's the variance analysis, and doing all that, calculating the different ratios. Non-financial performance measures are like looking into how's the customer satisfaction, what are the level of customer complaints, how are the repeated customers, what is the level of innovations that their entity is able to do, how's the training levels of the staff. So all those pointers will come in financial performance measures. Ideally, the suggestion is that we should use a comprehensive performance measure system which includes financial performance measures as well as non-financial performance measures. Clear? Okay. So now when I see the financial performance indicators or financial performance measures indicators, I would use ratio analysis for the same. Clear? I would use ratio analysis for the same. So now understand the different ratios that can come up is number one category is profitability ratios. You can calculate return on capital employed just like we did return on investment. Another way of doing the return on capital employed is also by use of this formula, which is operating profit by sales multiplied by sales upon capital employed. Operating profit by sales is operating profit margin ratio, and sales upon capital employed is asset turnover ratio. So these are also profitability ratios, but the combination of this also you can use to calculate the return on capital employed. Done? Now, how we can improve the return on capital employed? By increasing operating profit or by reducing the capital employed. But very major point is sometimes the entities, in order to increase the return on investment, what they do is they don't replace the old assets and they keep on depreciating the old assets. So of course the capital employed will go low and return on investment will go high. But this is not the correct picture of the entity. So this is not something that is to be encouraged. Okay. So we can also reduce capital employed by selling off the unused assets. Okay, we can, yeah, I'm sorry, I'll just do the correction. Okay, so we can reduce the capital employed by selling off the unused assets that do not add value. And operating profit margin ratio, can we know how to calculate profit before interest and tax divided by capital employed. That is also known as operating profit. How we can improve this ratio? We can improve this ratio by increasing operating profits. And how you can improve operating profit? By either increasing the selling price or reducing the cost. By any of these ways, we can improve the operating profit. And we can also increase the sales volume. If we increase the sales volume, then overall profit may improve. Yes. Gross profit margin ratio on the same lines like operating profit. Just understand that gross profit margin ratio is from the core operating activities of the entity, right? So improvement in that would require to focus more on the core operating activities. As asset turnover ratio, we just discussed the formula, sales upon capital employed. What does this ratio shows? That what is the increase in sales as a result of the capital employed. Typically it says that what is the turnover generated per dollar of the amount of capital employed. What is the turnover generated? Okay, so these are the different profitability ratios. Now let's discuss different liquidity ratios. But just allow me a minute and then we discuss these ratios. Okay, let's go forward. So liquidity ratios we are doing. Liquidity ratio means what? What is it evaluating? It is simply evaluating the yes, so it is simply evaluating the paying back capacity of the entity. What is the capacity of the entity? How much funds it has to pay back? The cash flow position of the entity, simply speaking. Okay, so now here we have multiple ratios. First is the current ratio, which is current assets by current liabilities. Ideal ratio is 2:1. That simply covers that are the current assets of the entity sufficiently covered its current liability or not. In, you can say, an extension to it, we see more liquidity position better with the next ratio, which is the quick ratio or the asset test ratio. Here simply what we do is, the current assets that we take, we reduce from it the slowest moving item of current assets, which is the slowest moving item, inventory. So we reduce inventory from it and we take the quick assets, or we take the liquid assets only, and then we divide it by current liabilities and we see the current ratio, the as a quick ratio. Then we have the next ratio, which is inventory holding period. Guys, you will be using them in your answering when you do the financial performance measurement of an entity. Inventory holding period is the number of days that an inventory is held by the entity. Of course, the more the number of days, the more it indicates it's a slow moving inventory, which is not a good sign. So it is calculated as average inventory by cost of sales multiplied by 365. Next is on the same lines, receivable collection period. That simply indicates how many days it takes for the debtors to be collected. So we calculate it as average receivables by credit sales multiplied by 365. Then we have payables payment period, and we see how many days it takes for us to make payment to our payables. Ideally, it should not be too less, otherwise it shows that we are having too much of outflows, right? So it will be calculated as average payables divided by credit purchases multiplied by 365. Clear? Next are the gearing ratios. Gearing ratios are nothing but the ratios that basically reflect the risk level of the entity, the gearing of the entity, how much it has a debt. So the more it has more reliance on the debt, the more highly geared it is, and which is not a good sign for an entity. Okay, so we calculate different ratios like financial gearing of an entity. Financial gearing of an entity is measured as debt upon equity or debt upon equity plus debt. Operating gearing of an entity, which are the day-to-day operating expenses, which reflect the liability angle, fixed cost, right? So here we will take contribution by operating profit. Why? Contribution will and operating profit, the difference is fixed cost, which is reflected here. So contribution upon operating profit is the ratio that we take. Interest coverage ratio simply shows us the times by which your profit is covering the interest. Okay, the interest cost for an entity. So of course we need more times the profit to be covering the cost, the interest cost. Okay, so here it will be calculated as PBIT, profit before interest and tax, and divided by interest expense. That simply shows the number of times that the profit is covering your interest cost. Clear? Absolutely great. Now, here I will just discuss a small concept of short-termism. Short-termism basically says when the managers are only focusing on the short-term objectives or achievement of the profits, where they are practically not looking into the long-term objectives that we have already covered when we did the goal congruence. Okay, this is just better so that they get a better performance evaluation. So now the question sometimes can ask you that how should you eliminate this short termism? How to make the managers look long term and look more towards goal congruence? What are the steps or what are the pointers to see here? Number one, having a goal congruence is essential if we want to eliminate short termism. That means not just the managers, the management should also work in a way that the managers feel a part of the organization. Okay, managers' performance should not be solely evaluated on the basis of performance targets other than and the other non-financial performance targets They should also be used to evaluate the performance of the managers, not solely on the basis of financial performance targets only, but non-financial performance targets should also be used, like the customer satisfaction, staff turnover, and so on. Clear? Okay. Next is how can we just set the targets in the qualitative areas, because that's very, very difficult, very difficult. So some steps to understand. Number one, find out the ways that drives the qualitative factors to improve the performance. Okay, the qualitative factors, how can we improve the performance? For example, declaring an employee as the best employee of the month, it's one of those approaches. Second, please check the acceptability or unacceptability of the staff towards these quantitative measures. Okay, that the standards that we are setting is this acceptable to them or not acceptable to them? Check that. And then motivate the staff by giving some financial giving some financial and the non-financial targets, so that the staff is motivated, giving them like employee of the month, give them a medal, that's a non-financial reward, but along with them give them a 1000 bonus coupon. So that is the financial target. So that is all going to motivate the employees. Clear? Okay, let's go further. Now, non-financial performance indicators are the performance measures that are apart from the financial performance indicators that would indicate the performance of a manager. For example, we assess the overall HR department, like with the level of staff turnover ratio, what is the gender ratio that they've hired, and leaves taken by the employees. So these are non-financial performance measures to evaluate the performance of a department, division, or entity as a whole. Clear? Any questions? You can ask me, guys. Okay, now I take up the two important areas, balance scorecard and the building block model. So quickly, when I cover the balance scorecard, this is the box which is very important. Balance scorecard means creating a balance between financial and non-financial performance measures. So here we create a matrix and a box, and in that we determine 4 perspectives. For each of these perspectives, we determine what are the goals and what are the key performance indicators. Goals are the targets that we set for each perspective, and we fix their KPIs to assess the performance. Okay, now what are these perspectives? There are you can say that 4 different areas basis on which we evaluate the performance of a division or an entity. These 4 performance areas are financial perspective, customer perspective, internal business perspective, and innovation and learning perspective. Okay, we can also call it as learning and innovation and growth perspective. So these are the 4 perspectives that we consider. Now look here. In financial perspective, the main aim of the organization is, what is the thought process behind it? To maximize the shareholders' wealth. So what are the different targets that you can set here? Then that is known as critical success factors, the targets that we can set. So what are the different critical success factors that we can set here? Number one, but to assess the profitability levels, to assess the liquidity levels, because that would make us understand whether the shareholders' wealth is maximized or not. Next is customer perspective. What is the critical success factor in KPI? That I will make you understand, but what is the rationale behind this perspective? The rationale behind is, are we able to satisfy our customers to the maximization levels or not? Because ultimately customer is the king, right? You work for customers. So is the customer satisfaction established or not? For that, again, what can be the different critical success factors? First can be customer satisfaction, and the key performance indicators that can help us to evaluate whether the customer satisfaction is there or not, by looking into the feedbacks given by the customers, number of complaints the customers have raised, percentage of the repeated customers, right? That can give us a fair idea about how are the customers, how are the customers taking this, how are the customer satisfaction level with regard to the customer perspective. Now, third is internal business process perspective, or we call it as internal process perspective, internal business perspective. The perspective here is looking from the internal controls point of view of the organization. That what are the different improvement areas that can be done, and are we doing any improvement in it? For example, a technology, let's say, is very outdated. Then are we doing any improvement to make the improvement in the technology to make it in line with the current trends or not? Clear? So the different ways, the different critical success factors to analyze this internal business perspective is, that is by which we know whether the targets are achieved or not. Number one, response time towards the customer's orders. How much time, this is one of the goals area that can be taken. What is the average response time towards the customer's orders that have been raised? Okay, so here what can be the ways by which we can check the target is achieved or not? Like number one, what is the time taken between customer's orders and delivery of the product? How much time does it take to log the customer order? Okay, so all these points we can consider when we look into the internal business perspective or internal process perspective. Next is learning, innovation and growth. Learning, innovation and growth means basically it looks into that how are we actually doing the training of the staff, what are the innovations brought in, how are we upskilling the staff. Simply it means what, how the staff is upskilled by giving them regular training. So the goal here is, what is the goal? Let's say the goal here is improvement in the level of customer service. Improvement in the level of customer service. So what can be the different key performance indicators? The training of staff, okay, the time taken by the staff to solve the query of the customers, that is to know whether the time taken by them is more or less gradually. That will show that whether the customer service quality is getting improved or not. Okay, so like this we draw down the different perspectives. And if you want to know in detail of this balance scorecard, people have uploaded a detailed video with a detailed exam question solving also in my channel. So please go on to your PM channel playlist in my channel and you will find it. Also, I'll do one thing, I'll upload the video link in the description box. So do go through it. Okay. Now, so finally, if I have to summarize the steps in the balance scorecard, I can say that my steps will be summarized here as number one, establish the 4 perspectives. Number two, identify the critical success factors and key performance indicators for each of these perspectives. Third, just writing down is not essential. Measure these performance against the actual performance and take appropriate corrective action to ensure that the goals are achieved and variances are removed. Clear? Let's go to the next one. This example that I've given, I've taken it in detail in my video link. So please go through the video link once. Now the next one that I'm taking and the last for this topic performance measures is building block model. And let's understand this, okay? Building block model is the model again for having a combination of financial perspective and the non-financial perspective at one place. And this was suggested by Fitzgerald and Moon. Fitzgerald and Moon had suggested this building block model. Okay. Now, typically, if you see building block, the balance scorecard is more relevant for manufacturing or the trading industries where you have goods. But when it comes to services, more than the balance scorecard, building block model is good because it is primarily created with the point, keeping in mind the service industry. You can say that. Now, when we see here building blocks, there are 3 building blocks that an entity will have. So in the building block model, we will have 3 blocks. Like in balance scorecard, we had 4 perspectives. Here we have 3 blocks. First block is the dimensions of performance that we call it. Second block is standards and the third block is rewards. Okay. Dimensions of performance are basically the different areas, the different activities, the different aspects of the performance which we are going to evaluate. So this is divided into 6 parts. And out of 6, there are 4 determinants of performance and 2 are the result of those determinants. Like for example, the first one is quality. So here we see how are the quality of the services provided. Okay. And then the next one is flexibility. That with the change in the customer needs, with the change in the technology, with the change in the environment, is the business able to adapt itself? If yes, then we will check whether this quality, whether this flexibility is actually having any impact on the competitiveness, is actually having any impact on the financial performance of the entity. Because if my quality improves, if the flexibility improves, of course, there will be more customers. So my competitiveness will improve. So my financial performance will also improve. So determinants, they determine the results. and resultants will tell us that whether the effect of determinants actually improve the results or not. Clear? Okay, now the next is, guys, innovation. Focus on my screen. Innovation. Innovation simply means what are the new things that have been introduced in your service line. Okay, so innovation that have been brought in the work, because of course it will also have an impact on the resultants. The next is resource utilization. It says simply that the resource utilization should be optimized in a way that the future generations also have the resources available, and in the best possible manner we should optimize the resource utilization so that the overall productivity and efficiency of the entity will improve. So these are the four determinants: resource utilization, flexibility, and quality and innovation. These four will give rise to results, that is competitiveness and profitability, financial performance. Okay, so this becomes your first building block. Now based on these, then we assess the performance. We will assess the performance with the standards. That is the second building block. Second building block standard says, boss, when you're giving targets, when you're setting the standards, make sure that the managers, they take ownership of these standards. Just giving standards is not enough. They should own the standards. They should make the standards as their own, right? They should be held accountable for it. Because the moment they own the standards, then they know that the whole congruence will be there. They would work towards it. Okay. Then second one, ownership is there. Second is achievability. The standards, like we already know in the basic concepts, that the target should be the one that are achievable. If I just simply say that, look, I'm going to keep a very high target, but then that is not achievable, what is the use of keeping it? Because it will demotivate the employees. So make sure that your standards are achievable. Third, your standards should be equity. That means there has to be equity. That means the standards set should be fair and equitable for all employees. No discrimination, no biasness for all employees at all levels. They should have the standards set with the same parameters. Okay, so that says that second block that talks about standards to be equitable, right? The equitable, to be ownership has to be there. So the standard should be equitable. There has to be ownership, and they should be achievable. Sorry. So ownership has to be there, achievability has to be there, and they should be equitable. Done. These are the three parameters in your second block. Third block is rewards. What is rewards? Now rewards are very important here. Rewards simply says that, boss, you achieved the targets. What are the benefit? Manager will say, okay, you've done very good, very good. That is not sufficient, right? We want rewards. Rewards is like the bonus, increments, rewards given to the employee. But again, the third block says the reward should also meet certain criteria. Number one, they should be very clearly set. I mean, they should be very clear to the different employees at all levels. It is not that rewards is only given to the higher employees and not to the junior employees. To every employee in the organization, they should be absolutely clear. So your policy should be absolutely clear about it. Second, they should have motivation. Now they say that, you have been the best employee of the year, and they just give you one certificate and they say, okay, bye bye, this is what you get. Is this motivational? No. You will find motivation when you get a bonus, when you get a holiday tour, for example, like that. So something in financial terms will be motivating the employee. Third, there has to be control. Control means that the comparison when we do with the standards, a performance evaluation must be done. Once we do a performance evaluation, the corrective actions must be taken to ensure that the variances are reduced. They are reduced. They are not there. Clear? So we have the three features when we say for a reward system. They should be clearly understandable. Number two, they should be, they should have motivational angle. And number three, they should be able to be, rewards are basically in relation to controlling actions, that they should be there. No, reward giving is thus not sufficient. The control actions must also be taken. Clear? Done and dusted? Very good. Okay, the last pointer that I'm taking from the non-financial perspective, I'll just take it quickly. But I just need a minute and then I will take it. Don't go anywhere, guys. We will be doing the ABC and the data and information part also. Okay, so now let's continue with the value for money. This is an angle from non-financial performance measures. Once we complete this, we are going to revise the ABC part. Okay, ultimate topic. I mean, which where every student tells me, ma'am, somehow it confuses us. So let's not be confused. Let's have ultimate clarity with that topic as well. Now be with me on this page. So we are doing here value for money. Value for money simply here, I know it is more tested for MCQs. So I'll just give you a tip to understand it. Sometimes the question will give you this understanding and will ask you that look, explain the three E's, or in this situation tell us how is the value of money impacted. So look here, see, value of money simply talks about that you have to focus on three E's. What are the three E's? The three E's are economy, efficiency, and effectiveness. Quick way, a quick tip to remember what does each relate to. When you have a question which talks about lower cost or cost angle, it is economy. Economy means lowest cost with highest quality. When your question focuses on input side, input output relationship, then it's efficiency. That simply here we see that what is the no, here we simply see how is the input generating the output, how is the input generating the output. Okay, that means what all inputs we desire and are they giving us a desired results or not. Okay, so whether the input is generating the desired output or not, or the maximum output or not. Here the question is the input that you have done, is it giving you the maximum output or not? So we are taking the input output relationship, which is efficiency. When it comes to effectiveness, here it is more from output point of view. Output point of view means that the output that you desire to achieve, are you able to achieve that or not? So your question that focuses on cost is economy. The question on maximum output or inputs that can derive maximum output, that is from input point of view, it is efficiency. The question that focuses on output, that whether we have been able to achieve the desired output or not, it is effectiveness. This is how you will remember your 3 E's: cost, input, output, like that. Okay. Lastly, sustainability, that I've already covered in our earlier topics, so I'm sure you can cover here. Okay, now let's start with ABC. So we are left with 2 topics. Let me just have a look at the screen. Look at the pointers here. We have done performance analysis and measurement. We have done divisional performance and transfer pricing also. Now I'm going to cover the remaining 2 topics. First, I'm going to take ABC and absorption, and then I will be taking data information systems. The last 2 topics, the final 2 topics for your PM revision. Okay, yeah. So let's have a look at ABC and absorption. Now look at my screen, guys. When I say ABC and absorption costing, let's quickly take absorption costing. What is absorption costing about? Absorption costing simply means that how do you absorb the overhead cost into the product cost. ABC and absorption both focus on overheads only. Okay, so here we see that how we can allocate the overheads into the product cost. Absorption costing, simple say, it's an age-old method. It's a very traditional method that simply says that look, the cost will be absorbed in the product cost. The overheads will be absorbed in the product cost. The overheads will be absorbed in the product cost based on a single rate. Single rate is you will calculate the overhead absorption rate. And what is that rate? Calculate the total overheads of the business, total overheads, and divide it by either the labor hour, machine hours, or whatever is the base given to you. So you will get rate per hour. Now for every product, see how many hours they are using and accordingly multiply the overheads to them. So the product, yes, that uses more hours, even maybe using practically less of the overhead, will actually get more overhead angle. Yes. So that is why it's a very big disadvantage, because unnecessary, just because a product uses more hours will get more overhead cost. The product that uses less hours will get less overhead cost. But how would it impact if I'm taking an overhead cost which is rent that has got no relationship with the hours? So in order to overcome the negativities or the disadvantages of this overhead system, the overhead allocation system, which is the absorption costing, ABC costing came in picture. So it is a modern method, very complex, very expensive, more suitable for complex organizations, less suitable for new organizations. The reason being it's very expensive as well. So it's more suited for established organizations. Okay, now here, please look here. When we follow ABC costing, now ABC costing simply says that boss, please do not follow one rate. What we will do is let's have multiple rates. That means if you have if you have 5 overheads in your business, don't combine it and take it as total overheads. For all the 5 overheads, please see what is that factor which is driving this overhead. That means what? For example, if I say rent, I know that rent should be allocated to every product cost based on the square feet that they are using, the area, right? So this is the driver for that cost. So like this, you will see what are the different drivers for the different overhead cost. Got it? Now, like for example, so then what are the steps that we follow in ABC? Number 1, please make the details, the different subcategories of the overheads. Then for every overhead, you assign the different cost driver. Third step, get the cost per cost driver. And fourth, allocate the overhead cost to the different product cost based on how much cost drivers that they are using for each overhead. Okay, accordingly, on a very practical basis, every overhead will be allocated to the product cost. Finally, you divide the total overheads by the units, number of units of the product, so that you get cost per unit. I think we can quickly take up a question so that we are absolutely clear on it. So I'll open the study text and let's take up a question on this. Just a small question so that you know how do we do the allocations. Okay, let's take up a quick question here which is there and I'll explain you with the solution. Okay, so how do we do this? Now let's have a question, and this question says, suppose that Technoworks manufacture four products A1, A1, B2, C3 and D4. Output and the cost data for the period just ended are given to you. A1, B2, C3 details are given to you. Now the direct labor cost is also given to you and the overhead cost breakup is given to you. 1, 2, 3, 4 and the total is given to you. What is the unit cost that you will have if we follow the conventional absorption costing system? If we follow the conventional absorption costing system, step 1, get the cost per hour. And here the question says use direct labor hour as the base. Total overhead cost is 30,800 divided by the number of direct labor hours. See here it is given to you, although machine hours and labor hours are same here, not a difference. So direct labor hours are given to you 1 per unit. Multiply 1 with 10, multiply 3 with 10 and just multiplying it with the number of units to get the total labor hours. Multiply this with 100 and this with 100. How much do you get here? 10, 30, 100 and 300, correct? You added 300, 400, 440 is the total labor hours. Likewise, machine hours will also be 440. Done. Now you divide it by 440 and get the cost per hour. So you will get here 30,800 divided by 440 and I get here 70. Now you will allocate the overhead cost or to the different products on the basis of the hours that they are using. Okay, so for example, I will just do the overhead calculation here. I'm not doing the entire question, just to give you clarity. Now, if I'm giving A1, B1, B2 and C3, I will write here what is the overhead cost per unit as per the absorption costing system. What is the overhead cost per unit? This is 70 per hour. And A1 requires 10 hours, right? A1 total requires, but we need cost per unit. Unit cost. Okay, A1 requires 1 hour. So 70 into 1 is 70. B2 requires 3 hours, so 70 into 3 is 210. C3 requires 1 hour, 70, and D4 requires 3 hours, so it will be again 210. I've got the overhead cost per unit as per the absorption costing system. Clear? Now let's get the overhead cost per unit as per the ABC costing system. Sorry guys, I'll have to erase this. Now I will just write here. These are the different overheads. What is step 1? Identify the different overheads that we have done. And these overheads are also called as activities. And the cost that you have got is known as cost pool. Why? See, because it is not that it is just one category of short-run variable cost. All the variable costs that will fall in this category, we summarize them at one place. And we give them only one heading, which is short-run variable cost. Because if we just take the entire heads of the company, the entire account heads, then it will be too lengthy for the calculations. So to ensure that it is not too lengthy, we do the ABC calculations like this. So these different overhead categories are the different activities or the different cost pools. Clear? This is step 1. Step 2 is identify the different cost drivers. Now the question tells me short run variable cost should be based on what? Setup cost will be based on the number of setups, will be based on the number of production runs. So production runs are 2, 2, 4 and 5 and 5. Add them together, we get 14. Get the total of everything. Okay, machine hours also is 440 total. So we just have practically production runs and machine hours. Setup cost will be based on number of production runs, which is 40, 14. 14. Short run variable cost also, wait, I'll just write it in, adjacent to it. Okay, what will be the cost driver for short run variable cost? And expediting and scheduling cost should be based on number of machine hours. And material handling cost should be based on the material handling cost should be based on the number of production runs. Short run variable cost should again be based on number of machine hours. Okay, so here, yes, in the exam, you can have this difficult point where sometimes it becomes difficult to identify that whether I have given the correct driver or not. So that becomes a challenge, and for that, we need to be very clear. I think we can just have a look at it again. Okay, let's see this. Short run variable cost, is my driver correct? 440. Okay, now here I've got the drivers. Third, let's see what is the cost per cost driver. I'm just telling you all the steps. So the steps that you need are very essential. Okay, I hope we are clear till this point. Anybody having any doubts, just put up in the chat box quickly. Okay. No, but I think that expediting and scheduling cost should be as per the production runs. Scheduling is always as per the production runs. And material handling cost will not be as per the production runs. I think material handling cost handling is, there is no direct indicator given. We can take output units. 220 units, let's take. Okay, 220 units we will take here, and let's do the calculation. I think that's more appropriate. Yes, you can have multiple overheads. I mean, cost drivers. You can just give the assumption. I am taking material handling cost for the number of units. I find that I am not getting any direct relationships. I think by cost, by units, it's a safer side that I'm taking. Okay, now let's get the cost per cost driver is just step 3. So cost per cost driver will be 3080 divided by 440, which is here 7. Then the next one will be 10920 divided by 14, you get here 780. The third one will be 9100 divided by 14, you get here 650. The fourth one is 7700 divided by 220, I get here 35. So this is my cost per cost driver that I've done. I'm done. Third steps is over. Now fourth step requires that you please go to your product and now allocate this overhead cost to the product based on how much cost driver they are using. So I'm just telling you orally that can be done. For example, if I'm taking product A1, then if you see short-term variable cost, we have done it on the basis of machine hours. For every unit, machine hours taken is 1, right? If you multiply 1 with 7, you will get the overhead allocation for short-run cost. But when you do the allocation for ABC, remember you will do it for totality because you need to match it with the total cost. So don't never allocate it per unit. So what you will do is A1 requires in total 10 machine hours, 10. And every machine hour will be at the rate 7. So please multiply it. Like this, you will do the multiplication for all the products, add all the overheads for every product, get the total overhead, and then divide by the number of units. And then you will get cost per unit. Maximum students do this error where they initially only they take cost per unit. Never do it. When you're allocating the cost and doing the step 4, take the total overhead cost for every product. So that first you can always match the total overheads. First and the foremost. Then when you get the total overheads, then divide by the number of units of every product and get the cost per unit. And then you can compare it with the absorption overhead cost per unit to see how is the effectiveness. In your exam question, you will definitely get one ABC question. Definitely. Either as section A or section B or section C. Typically, it is more asked in section A. When the question will give you data and tell you to calculate the cost per particular product, cost for a particular overhead. If you need to know how to solve such questions, go to my section A marathon. I have taken questions over there. Okay, now let's go to the next question, the next topic, and the last topic that we are taking, which is managing data, information, data analytics, and all that. Okay, let's cover it here. So let's do that part. I will take that portion from the book only. Okay, first and the foremost, this is the book, guys, that is available to my students in the class, and we do studies from here. Now, the managing data and information, this topic simply talks about understanding what is data, which is raw form of data. Okay, raw information, not information, I'll say raw content that you have is data, and information is a processed form. Clear? Now here, what is tested in your exam is not this. What is tested in your exam is what are the information systems. So let's quickly take up the information systems here. Okay, and also what is tested in your exam is information technology. Let me take this first. When I take up information technology, number one, the question here is how you can share the information. So we can use the different networks to share the information, by which a network among the computers is created to share the information. Okay. Now, one of the way by which we can share the information is intranet. Intranet is simply a private network used by an organization. For example, you are an employee of Deloitte and you want to access your employee platform that's privately available only to the employees. I, being a third party, I cannot access the employee portal of Deloitte. I can only access the website of Deloitte, which is available to the public in general. So that is available on the public network and not on the private network. Private network is which is accessible by the employees only, and generally it is connected through internet. Okay, so the common uses would include like the company's announcements, newsletters, trading materials, the payroll information, everything. Then one of the other ways using the wireless technology that we commonly call as Wi-Fi technology. It helps the staff to use internet even when they are away from the office. So the work can still be done. Mobility is there, and nowadays everyone is just using Wi-Fi. Very rarely we use the LAN wires. Okay, the internet is the freely available source which is available. Although yes, we do pay for it some or the other point, but internet is the one that connects everybody throughout the world, and the world becomes one for it. So you can connect with your stakeholders, you can connect with your employees, with the suppliers, with the customers, with the future customers, potential customers, all that. So like e-commerce is a better example for it. Extranet, very important term. Extranet is just an extended version of your private network. So it's like the entity has an accounting system, and let's say there are some reconciliations and there's some places where they need the suppliers and customers also to be a part of it. For example, I would give you a very practical example. Let's say when the entity goes for JIT systems, just in time inventory systems. So then, and just understand that in case of just in time inventory systems, uh, the entity requires suppliers to be having online information, real-time information of their inventory, so that whenever the inventory levels go down, okay, whenever the inventory levels go down, the suppliers can get an access to it, and they would immediately know the inventory levels have gone down, and they can recoup the inventory and provide it to the entity, instead of entity reminding them regularly. So it is one of the places where extranet becomes very useful. Then cloud computing, we know that we do everything on cloud, data is saved on cloud, so that's today's, that helps to reduce your IT cost. One of the other topics also which are very popularly asked in exam is data visualization. I know it's a very simple topic, but it is asked. Data visualization is nothing but presenting the data in a way that is visually attractive and visually appealing. Okay, so the audience can immediately connect with it. Okay, next. I want to take up the information systems which are frequently asked in the exam. So let's just quickly have a look at it. So when I take up the types of information system, number one is transaction processing system. Transaction processing system is just a data entry, nothing else. You're not doing any activity on it. Here it simply means that you are just collecting data, storing data, modifying data, and entering the data into the computer system. That's all. So it's just the first step, you can say, that we need when we are inserting the data into the computer system. Okay, so that is just the basic step. MIS, Management Information System, is just a way to monitor the performance of the organization. See here, effectively, the middle level and the operational level are involved here. Typically, the middle level, not the operational level. TPS, Transaction Processing System, is an operational level work. MIS is a middle management level work where you prepare reports and submit to the management so that they will have a bird's eye view of what is happening in the entity. Okay, then executive information system, very important. It is the information system of the management, and it is the only information system that connects the internal data with the external data. Executive information system only uses the external data, that is level used by the top management, so that they would know about the sales movement, the market size, market share movements, and so on. That would help them in making the strategic decisions. So it is generally not used by managers or operational people. It is used by the top management. Okay, then we have ERP system. ERP system is the comprehensive system that we use. SAP is a very good example of it. Oracle systems are also example, where basically the entire organization becomes one. So be it any department, throughout the organization that has branches throughout the world, they all are connected together. So a change that is brought in one of the departments at one of the place will be reflected worldwide. So that is the single software that helps and meets the requirements. Okay, so that is ERP systems. Customer relationship management system. I'm explaining you these systems with a perspective because match the following: true, false, MCQs when they're asked, you should be able to handle it. Okay. Now, customer relationship management systems. What are these systems? People, these are systems which are specialized softwares. These are the specialized system softwares and applications that manage information about a company's products, services, customer interactions. So you see, you find a customer representative talking to you when you file a complaint with maybe any telecom provider. They use CRM systems, customer relationship management systems. Okay, that's a database that typically just revolves around customers, every data relating to them, their complaints, their loyalty points, everything. So when you call that customer service person, you're actually connecting to a CRM system. So they have restrictions. They cannot see the entire company's data. They are just restricted to the customer data only. Clear? Now, big data is the data for today. Let me just give you a brief idea about what is big data. Big data is simply the data which is involving a huge amount of data to assess. For example, I want to know for my business whether my customers, what is the next kind of product that they would like. Or when I open Amazon and I want to order a product, the moment I order it, the next time when I open Amazon, it will show me the same data, the kind of a similar searches. Even on Google, if I do, I will get the similar searches because my behavior pattern is caught by the big data. So let's say if you buy something from a departmental store, you will get a lot of ads relating to that, that kind of item category, so that it will prompt you to come next time and be a repeated customer. So that is where big data comes in picture. It picks up every data, whether from social networking, whether from your emails, which is more organized data, or any other reports that have been published, which is even more organized data. So whether it's a structured data like reports or semi-structured data like email, which is not fully disorganized like social media, but less organized like reportings also. So it will pick your data from here, it will pick your data from social media, what you do on Instagram, what you do on LinkedIn, what you do on Facebook, what you do on X, everywhere the data which is there is captured here. Okay, so it takes a combination of structured data, unstructured and semi-structured data, and therefore big data is the need for today, but at the same time it is very risky also because your entire data is open to the public. Well, now, what are the characteristics of big data? Very important. 5 V's. One is volume, the data volume is huge that we discussed. Velocity, big data is processed at a very, very high speed. It is not processed by the normal computers. We do the cloud computing or the other ways to process big data. Number three is variety that I told you. We have semi-structured, structured, all photos, videos, text, everything is there in big data. They will capture everything, analyze it. So big data uses AI technology, yes. And they capture, analyze, and then give us the result. We have data analytics that we do is big data only. Now, next one, variety that we have done, veracity. Veracity is the dependability. Like, for example, you insert a data in ChatGPT, for example, right? It uses the data which is available on the internet, right? And gives you with a solution. Is it actually accurate or not? Not necessary. Not every time your ChatGPT or AI platforms will also give you accurate data. So you need to always check it. Plus, your personal privacy is compromised there. So this is a big, big hindrance when we give big data the entire access to everything. Next is value. Value is, yes, big data do brings value because at even a very low cost, that is the cost generally that we need to do cloud computing when we use a Google cloud computing services, AWS services, or their various providers. So when you use those services, then yes, you incur a cost, but the benefits that you can get by doing effective utilization of the big data is huge. They reap huge benefits. So yes, big data is the need for today, I think. With the data that we have, with the world that we live in, it's very, very essential. So data analytics, like I told you, data analytics is nothing but it's a process of gathering the data, analyzing the data to bring meaningful results for the clients. It includes four main categories that are descriptive analytics. Descriptive is, it simply explains what is happening here. Diagnostic is to explain why it is happening. Okay, why sales are falling. So that is a descriptive analysis. Predictive analysis is doing predictions for the future. And prescriptive analysis is the recommendation, the course of action ideally that we recommend you to take. Okay, this is the actions that are done by data analytics, and they are simply ACCS who are doing these data analytics and giving us the answer. And they make the use of big data to do this analytics. Okay, then another term that I would use is here data mining. What is data mining? Data mining simply means that you use specialized softwares and they identify the hidden patterns, trends, relationships within the large volume of data that help you in doing the decision making. Data mining is going to deep dive into these topics and the subjects. Okay, so for example, I want to know about the behavior patterns that I have available on the social media. But I used more softwares to see what were the purchases that were made by the customer in the last 6 months. So that will help me to make the predictions more better for that kind of customer. Clear? Yes. So we are clear about data mining also. And just one more point. What is the big data pyramid? Very frequently asked in exam, guys. What is big data pyramid? Big data pyramid is this. It simply says you start from below. Data is the raw form. You process it, make it information, right? And it says that when you interpret this information and you draw down conclusions, you are into knowledge level. When you use them for effective decision making, that's wisdom. So big data pyramid includes data, information, knowledge, and wisdom. Clear? So data is always working on past data. Information, like I said, processing of the data to know the patterns, relationships, again on the past data. Knowledge is you run analytics on this past data to see how the things have been done, how we can achieve the goals. And finally, you use them for future outcomes, future predictions, and that is known as wisdom to create better decisions. So here we discuss why. Okay, I hope it is very clear. So I've given a very good example here that I would take a data pyramid example. For example, what is data? Data is when your learning provider tracks the students and the pass rates and they tell you about what is the introductory business spreadsheets. They give you introduction to the different courses like ACCA PM. Information is now students will enroll for these courses and they can take a pairing also, combination of these courses also that they take. So they are now processing this data. Not knowledge is not doing the analysis. Analysis means that now we do the analysis that the students who took two subjects, what is their pass rates? Who studied one subject, what is their pass rate? Who studied three subjects, what is their pass rate? Clear? And finally, wisdom. With this wisdom that we see that based on these the past percentages and the results that were drawn down, then we focus the kind of students in the future. So that is basically then we link the different courses with the PM course also. For example, if I say that if you do PM and with that you do PM with tax, it gives you great results. PM with FR gives you great results. So like this, if we go combinations and then we interpret this for the future. So that would help you. That is the wisdom angle. Using this past data to do interpretation of the futures and doing the forecasting. That's all. That's all, my friends. And I hope now it is absolutely crystal clear doing these questions. Understanding the different topics. So as promised to all of you, as I had promised that I would be covering 100% revision of your PM syllabus, I have been able to deliver it, I believe. All of you, when you watch this video, and please do the sharing in your comment section. Please give me your feedback to tell me how did you find these revision sessions. Did it really felt helpful to you for this last minute revision which was missing in your planner? I'm sure yes. And for any questions and queries, you can always drop a WhatsApp to me and I would be really happy to help you for that. You will find that in the description box. Also, don't forget to go through section A and B marathons, highly essential. Go through the on-screen calculator video as well to use on-screen calculator in the exam and the multiple videos which are there in my playlist. All the best, guys. Do well. Have a very good exam and give your best. Just make sure that you remember that you have to complete your paper in full. So do the effective time management. How to do that? Watch my video on it. Thank you. Thank you so much for joining, guys. Bye-bye. Take care.